out is what is their plan out 3 or 5 years? Jamie Dimon's really articulated that in his widely read annual note, but I need to hear from these CEOs in their conference calls. What's the 2025, what's the 2028 fintech view? They don't have one.
And Tom, I think they would acknowledge that they missed it. Jamie Dimon at JP Morgan, a phenomenal leader, who is really responsible for what Wall Street looks like. Let's be clear about that. But one thing I think even JP Morgan acknowledges, Tom, the likes of Square and others, they missed it. And now they've got to spend. And they've got to buy as well, potentially.
They got to buy.
The M&A part of this is going to be interesting. And I know Shanali's done a lot of work on this over the last several months, but that's going to be a hot spot as well that we need to focus on. And the man who has really opened up the wallet over the last couple of years, that hasn't been Jamie Dimon, has it, when it comes to purchasing and M&A and all of that? It's been Mr. Gorman over at Morgan Stanley. That's the man that's got your attention.
And he's done some strategic things in wealth management, particularly with the Eaton Vance acquisition. I would say it's a little bit away from the tech part and much more towards his comfort, his wheelhouse as well. John, the other thing we've got to look at today, and I'll be honest, this has to do with banking as well. We had a transaction yesterday that was done completely outside traditional financial banking. It was done in private equity, and the debt financing for that, including Blackstone, was done in what's called private debt. The FT wrote this up beautifully overnight. What is the future of banking 3 to 5 to 6 years out? John, I don't know, into the mid-year 2021.
I don't know either, and I think that's maybe part of the thing that's kept these banks back, Tom. These haven't been the big performers over the last 10 years. The big performers over the last 10 years have come from somewhere else. They've come from big tech.
Well, it's come from big tech, and that's a nice window, John, into the bombshell this morning, which is a repricing on Apple. This is, John, for the end of the month, not for this week, with the bank earnings coming out in that. Jim Suva goes up to $170, up 16%, many, including Dan Ives, above him. But, John, it is a proxy. The Apple success, the Apple reset at 148 this morning is a proxy for that big tech.
Do you know that we haven't seen a new high on Apple until very recently, since the start of the year?
Yeah.
Some of these names, Tom, have done absolutely nothing until very, very recently. And that 8 weeks of gains that I talked about in the NASDAQ 100, that's really important. I think year to date now, and I'll talk about this a little bit later, year to date, the NASDAQ has now outperformed the small caps in America. There's a story there. And I think also there's a story there for the Federal Reserve about growth and the perception from some people in this bond market that the Fed could choke it off. Now, if we really think that a little bit later, Chairman Powell is auditioning for a second term at the Federal Reserve, do you think he wants to sound like a Federal Reserve chairman that's about to choke off growth anytime soon?
Well, he's not going to choke off growth, but also job formation. Look at the job formation of Amazon alone. John, I'd point out Apple up 27%-ish off of the bottom in March. Right now, let's swing back to banks. Very important right now. And in particularly, we see with the breaking news of Sumitomo Mitsui to do a joint venture with Jefferies as well. Ken Leon joins us with CFRA. Ken, let me ask you about out 3 years rather, the vision that we see. Are we going to see a consolidation in the financial space that you follow each and every day?
The consolidation will happen, yes, and it's happening below the largest banks for regional banks and the smaller banks. There are still thousands of U.S. banks that can still consolidate, but the disruptor is fintech companies that accelerate consolidation because they're looking at digitalization to replace bricks and mortar.
How do they compete with JP Morgan and the others from Bank of America today? How do they compete with big people with big budgets?
It's increasingly more challenging because many consumers are banking via their mobile phones or by their laptops, which means that local presence and relationships is almost a legacy look in the rear mirror to really older baby boomers, because digitalization is changing how we live and how we bank.
Ken, in the meantime, people are looking at consumer appetite to borrow at a time when they're flush with cash, and that's really going to be in the forefront of many people's focus when they take a look, particularly at Wells Fargo data that comes out later today. What are the signs you're looking for that even if we don't see loan growth now in that capacity, it will pick up later this year and that we are close to that turning point?
That is the million-dollar bet, and that's part of the reflation trade of having a stronger recovery and consumers beginning to spend. What we learned yesterday with JP Morgan, and we're going to definitely get today with Wells Fargo and the other banks, is whether the consumer is levering back up. They're flush with savings. We have seen an increase in consumer spending, even on credit card. Auto loans are strong, but they're paying on time, which means loan balances are not going up for the consumer. That is a serious issue. Certainly, you know, the V-shaped story for the second half of this year for large banks probably is over, and we're really looking to the narrative for 2022 for this recovery and increased lever of the consumer and the household.
I love that this is considered a bad thing. People are actually able to repay their loans on time, and they're not racking up huge credit card bills. They're saving money. Oh, what a terrible thing for banks. Going forward, though, there is a question of whether these banks are a buy, given the valuations where they are, if Treasury yields don't go up, and if people continue to use their savings, that stymies borrowing to the extent that people are expecting through the rest of this year.
That's correct, and these stocks are still valued well below the valuation of the market, the S&P 500. They're very attractive, I think, for investors in portfolios of growth and income or equity and income portfolios or funds. And we think that when you look ahead, the math of the economy growing, whether it's the U.S. or global, is not likely to be this parabolic move we've seen this year. So we think you need to have some position in the banks. Unfortunately, the momentum for the second half of this year is neither going to come from the consumer or from the widening in terms of net interest margins and higher net interest income in a big way. And that's really important for banks.
So, Ken, what does that mean for how I allocate capital to this sector then? Do I want to do it passively through a basket? You've done pretty well doing that over the last year to date as well. Or do I need a crystal ball? Because at the start of the year, if I had a crystal ball, I would have sat in Goldman and I would have sat out of JP Morgan, sat in Goldman and got a gain of north of 40% year to date. What would you suggest people do right now? A basket or get specific?
You know, I think in terms of fund strategy is certainly to have a basket where you're going to play different areas of the financial sector. And that would be banks as well as non-banks, consumer finance, insurance. So you're diversified. Within looking at banks, you know, we have more of a weighting with strong buys in Morgan Stanley and Goldman Sachs because we don't have to worry as much about the consumer or a rising yield curve. But certainly there's quality names in there like JP Morgan as well.
Ken, when do the likes of Square, the likes of PayPal fit in with all of this?
It's really hard to see what the outlook will be for the large banks. They will defend. They're investing billions in technology, but the ability where you change behavior in the consumer in terms of how they shop and how they bank is something that worries the large banks. And certainly we could see some tactical acquisitions. So instead of your first question, the direction of consolidation within the banks, we're likely to see the large banks move ahead looking for disruptors in technology that helps them to defend or grow in this new era.
Could you see one of these big players getting with a company as big as Square, Ken? Could you envision that? Do you think that can happen?
It's hard to say. My analogy would be Walmart versus Amazon, and Walmart certainly did that, and now they're respected in terms of a shop online and home delivered. You know, so I think for the large banks, they're making some acquisitions in venture capital. They're increasingly having a seat at the table for these really substantial changes going on with technology and banking.
Ken Leon of CFRA, the Equity Research Director, is going to be sticking with us as we await Bank of America. And just talking about Square, Tom, we're talking about a $100 billion company now at Square. So when we talk about M&A with some of these tech firms, you've got to really get your hands around the size of them. Deutsche Bank at the moment is just north of 20 billion euros. We're talking about a company 4 times as big. These are big companies that we're having a discussion about M&A.
And there's the little companies as well. The singular news, John, is the behavior of consumers, and you see that in the panic at Goldman Sachs and Apple to set up an Affirm equivalency. AFRM hasn't done all that well. It's a smaller company. The stock's traded off, blah, blah, blah. You know what? It's simple. The big boys are petrified of how consumers are changing how they buy things.
Quick final word, Lisa, before these numbers come out.
I'm just wondering if Trustbuster Biden is going to, if that's how he's trying to make his name, how he's going to allow, some of these big banks to acquire other big financial tech firms. And frankly, with all the M&A activity, I wonder how he's going to respond.
Did you come up with that name?
No, I think that...
Other people are going with that.
I think so.
Okay.
I hope so.
Just not heard that before. Tom Keene, Lisa Bravids, Jonathan Ferro. We're waiting for Bank of America numbers. They're moments away. Equity futures 43.65 on the S&P 500 from New York. This is Bloomberg.
With the First Word News, I'm Rishika Gupta. President Biden says it's a national imperative for Congress to pass voting rights legislation to counter state laws passed by Republicans. The president called the efforts to curb ballot access, quote, election subversion. The latest flashpoint is in Texas. Most of the Democratic representatives in the state house left for Washington in order to prevent the Republican majority from passing new voting limits. Germany's Chancellor Angela Merkel will have a message for President Biden when they meet at the White House tomorrow. Europe wants a seat at the table too. Merkel and France's President Emmanuel Macron are pushing for the European Union to have more of a say in relations with Russia and China. And at the same time, Merkel is likely to acknowledge President Biden's moves as those of a dependable ally. And it's a remarkable turnaround from a year ago when the pandemic sent the U.S. economy into a tailspin and decimated oil consumption. Now, demand is at the highest level in 3 decades. Gasoline and diesel demand is at pre-pandemic levels, but the recovery is being propelled by a surge in petroleum used for products such as plastic, asphalt, and lubricants. Kathy Wood's ARK Investment Management has been selling Chinese tech stocks. China's weighting in Wood's flagship ARK Innovation ETF has plunged to less than 1%, from 8% as recently as February. Wood says there's been a valuation reset in Chinese tech stocks. Beijing has intensified its recent crackdown on that sector. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
New York City for our audience worldwide. Here come the earnings from Bank of America. Let's pour through them, shall we? It's been a soft spot for these banks in the last 24 hours. It's fixed income trading, and the numbers look like this. 1.97 billion. That's the number. The estimate 2.44 billion for fixed income trading. For trading revenue more broadly, $3.6 billion. The estimate 3.78 billion. So just a little bit lighter there as well. EPS coming in at $1.03 versus 37 cents year over year. Just getting a couple of details, some lines coming from the CEO, Mr. Moynihan. Over 85% of buildings, offices are open. So Tom's slowly getting back to normal. That's the commentary coming from Mr. Moynihan. But the numbers softer on trading again and softer on fixed income trading specifically.
Just diving into the PowerPoint, and they do a very nice job. Each bank reports different tone, different ratio as well. But yeah, I would suggest, John, it's a pandemic struggle. There's a little bit of a struggle here on first blush.
That stock coming in about 0.5%, 39.65 on Bank of America. Citi coming a little bit later, Wells after that. Just to go through the numbers, that was the soft spot, Lisa, that many people were looking for.
Yeah, the other thing that I think is really interesting, just to throw another figure in here, is that the deposits were up 21% in the quarter, even as Brian Moynihan said that consumer spending significantly surpassed pre-pandemic levels. There still is so much cash in there, and the fact that this is actually pressuring bank balance sheets is an ongoing conundrum. But again, given the 23% increase in deposits over at JP Morgan, to see this sort of increase from already elevated levels raises some serious questions.
And Tom, just quickly, a reserve release of $2.2 billion over at B of A, following a big one over at JP Morgan
yesterday. I flunked that on the CFA exam. That's money moving around on the table that doesn't affect people. You know, the reserves are there, and the release of them in good times like we're having right now for banking. Just one chart, John, that really gets my attention here. This is buried on page 4 of the presentation. And this, John, goes to the modern banking and Square that you were talking about. Credit cards, 30 days past due, is just simply in this stimulus America, down, down, down. It's a better picture for consumers.
Yeah, just additionally, Tom, before we move on to Shanali to get her take on these numbers, I think it's interesting to blend in what Mr. Moynihan is saying about in-person meetings. They're raising growth in wealth management. They raise consumer product sales. It's quite interesting. He's talking about how much of this business is open and how important in-person meetings are.
Yes, they are.
I was kind of surprised that I didn't hear more of this yesterday, but you're hearing a lot of it from the Bank of America boss.
Well, we need a surveillance in-person meeting. We've got to get you and Lisa in here. Sonali and I are holding court here at a hermetically sealed desk. Sonali, what do you see? You go into this, they're all different, and Bank of America is a unique presentation.
Yeah, it is a unique presentation. Listen, net interest income is the thing that people are worried about for Bank of America and JP Morgan.
Traditional banking.
Traditional banking, $10.3 billion compares to $11 billion a year ago in the middle of the pandemic. So that tells you how tough this business can be. IB fees are in above expectations, so you see them really fueling that debt capital markets engine way above $1 billion and helping the investment bank is really helping the consumer bank really offset those challenges. Fixed income trading, people expected them to come in bigger than Goldman Sachs in fixed income. They fell short of expectations, well short of expectations. There are going to be questions about whether there were market share losses there, given that they fell so short. Equities did come in all right. So all in all, very mixed results. But as you guys have been talking about all morning, mixed is not going to cut it.
The CFO says total loan balances grew for the first time since the first quarter 2020. That's going to be a big part of the story going forward from here, Sonali. What are we learning from the likes of JP Morgan, the likes of Bank of America on that theme?
Yeah, that loan balance question is a big thing. As we know, credit cards not growing. That is a tough thing for a firm like JP Morgan, certainly for Citigroup, as we hear them report later today. For Bank of America as well, we're going to want to watch that mortgage business as well. Our home loans rising. That was also kind of challenged at JP Morgan as well. So again, mixed bag here. It's not enough to appease investors. Part of this is interest rates. Bank of America has promised they'd be shifting more towards fee-based businesses, right? Even Goldman Sachs, that was a big promise they gave investors yesterday. More fee-based, recurring, predictable revenue. So that's been the story lately on Wall Street.
And Chanel, you talk about how it's not really quite good enough for investors, and certainly you're seeing the initial knee-jerk reaction, which is not predictive and not that big considering how big the rally has been to date, but is still down more than 2% in pre-market trading. How big of a concern or a benefit is it that the deposits on the bank's balance sheet grew by more than 20% at a time when they want to see people spending their savings?
Yeah, it's not so much just the deposits, although what's shocking to me is hearing analysts quarter after quarter asking Brian Moynihan and asking Jamie Dimon if they're going to get to the point that they start turning away deposits. That's something we have not seen in this country, right? But it's that loan to deposit ratio that's concerning to regulators. Why aren't banks lending in relation to the deposits that they're taking in? Digital usership, guys, is also up very, very significantly, even into this pandemic. And as things start to reopen, the question is, what is Bank of America's brand strategy and real estate footprint? Jamie Dimon yesterday said they have opened 200 branches, half of their 400 branch goal. So it's not that every bank is stepping back, just across the industry on average they are.
Chanel, I'll keep diving into this. Ken Leon with us. And I do want to say, folks, and it's just an opinion, but when we look at 4, 5, 6, 7 banks, the chart presentation of Bank of America in the heat of an earnings release is absolutely best in class. There's no other way to put it. Ken Leon with us with CFRA. Ken, Brian Moynihan has the courage to put the efficiency ratio up in a gorgeous chart. Before the pandemic, the number was a brilliant 60%. After the pandemic and in the pandemic, it's not. Do you have a belief that the banks can get back to the constructive efficiency ratios of the past, or is that days gone by?
It's only for the problem banks where the efficiency ratios will stay elevated, and that would be perhaps Citigroup and Wells Fargo. But for Bank of America, JP Morgan, the answer is yes. And then you got to look at what is the efficiency. It's essentially in how they operate, and with their investments in digital and technology, it enables them to improve that ratio. So it's a simple ratio that captures their whole business. It's kind of a second derivative for analysts as we look at what is performance.
I see a moonshot on the chart, Ken Leon, and it's what John Farrow is talking about. We're using digital. We're using our phones. The Zelle, Z-E-L-L-E, folks, we all move money around to our kids on it. Ken Leon, what does Zelle mean for Brian Moynihan, James Dimon, and the rest? Just up we go in cell phone payments.
you want to definitely be a player and take advantage of how society is changing behavior, how they shop and how they spend. But don't get distracted, and I don't think Brian Moynihan and management is at Bank of America, that a physical presence will help them now for the delayed rebound of the consumer for banking and small business loans. They come to a local branch or to a financial center. So we're also seeing market share gain of the large banks in even the top 100 metropolitan markets in the U.S. So it's kind of a boring strategy, but incrementally that's going to help them, especially when we see a pickup in loan activity. Unfortunately, Tom, I think that's with confidence in 2022, not for Q3 of this year, and maybe we get a glimpse of that later this year in
Does
Q4.
that come down to what's happened on the fiscal side, Ken, for you to get a decent read on what's happening with loan growth?
So much of the catalyst here for loan growth is really the consumer. It's not commercial or corporate. They're flush with cash. They have access in the U.S. market to the capital markets, and we saw that in fixed income underwriting. But, for the consumer, you look at the Fed data across many metrics, household savings, the ratio of debt relative to their income, and they're at record lows. So it might be, we got technology going, but the consumer is more conservative. It's like coming out of the Depression of the 30s or the financial crisis. They're saying, we're going to pay our bills and we're not going to let these credit card balances rise as much as they can. That's a big story as we go into the next quarter, because we're going to see if that's really true.
The big distinction there, of course, they've come out of this one on aggregate wealthier, not poorer. That is the big distinction this time around. I know Alison Williams of Bloomberg Intelligence, you as well, Lisa, have written about this in the last 24 hours, that distinction between Main Street and Wall Street, companies and consumers, and how that cash is being deployed.
The idea here that you can bet more reliably, and that's what we're seeing in the stock price, on banking, on mergers and acquisitions, deal making, other types of financial markets activity than for consumers to be profligate with their spending. Going forward, can we continue to rely, can investors continue to rely on the banking activity to support any lag in lending until that picks back up?
The banks are strong. The balance sheets are incredibly at great levels and return of capital. So I think for the consumer, the banks are solid, and for the investor, there's return of capital. We had substantial increases of dividend and buyback they could do after the Federal Reserve stress tests. And keep in mind, the whole battle here again is after capturing wallet share of consumer spending. But we didn't talk about today the strong results of the asset management and wealth management businesses here today for Bank of America, but all the large banks. And this is great because this drives for investors confidence on recurring revenue and cash flow.
Ken Leon of CFRA, thank you, sir. Ken Leon there weighing in on these numbers. Bank of America out just moments ago. Trading coming in a bit softer than anticipated after the banks yesterday already lowered the bar for that particular part of the bank. Looking at the numbers this morning, we're down to 38.90 on Bank of America. Negative a little more than 2% in the pre-market, Tom. Just a little bit of a disappointment here in certain parts of this bank.
What's fascinating to me, John, and again, I give them the highest credit for the chart-driven presentation they've done. You can glean so much from this presentation. Folks, this is very available to the public as well. And John, what I would suggest is if there wasn't a pandemic, would these banks look like they look now?
In what way, Tom?
Everything's been sped up. I think the whole digital thing, with everybody, these are not essential workers, but with the tragedy of this pandemic, the banks have sped up their digital experience by 2, 3, 4, 5 years.
The irony is that maybe the consumer balance sheets wouldn't have looked as good, at least without the pandemic. That's what's bizarre about the last 12 months.
Well said, yes.
Well, it mutes the reaction function in the economy and in financial markets on every level. And frankly, John, how do we get a clean read on what's going to happen when all of the signals we've relied on the past are just gone?
And how levered, how exposed are these banks still to this underlying economy, given some of these forces? Coming up, Steve Major of HSBC on this bond market, south of 140, 139.46 on 10s from New York. This is Bloomberg.
is entirely online, ostensibly because of the pandemic, but in large part, we're seeing a massive pivot to mostly live streams for video game coverage. We're going to be all online instead of in the convention center for the first time this year, and that promises to be a really different experience.
Industry has really been interesting during the pandemic. It has actually grown substantially since everyone was stuck inside. And of course, this makes sense, right? We're all looking for some amount of entertainment, and stuff like Fortnite in particular offer also a social component, right? People can join up and kind of meet up online and spend time with their friends. So in a lot of ways, this all makes sense.
I think what we've seen during this period of time is that communicating via video is not a fad, that we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
The consumers have been venturing out into the real economy, and they have been gradually putting that cash to work.
Americans were flush with cash. They didn't need to borrow, but that wears off.
When you look ahead to the next few quarters, we very much believe the economy will be still growing well above trend.
When things get really bad in markets, there's no doubt that volatility is going to spike.
We're just blowing away a forecast that was already revised up by a percentage point at the last FOMC meeting. So when does the Fed recognize that?
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Chairman Powell just hours away from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Equity futures 43.64 on the S&P, just off all-time highs, Tom. What a morning we've got lined up once again this Wednesday.
It's the same thing. The news is different than it was at 9 p.m. last night. This is a radically different Wednesday than I expected, John, even 12 or 18 hours ago. I do want to note there's a NASDAQ lift off Apple News, but John, the focus has to be now in this changed Wednesday on Chairman Powell in Washington.
The NASDAQ up 43, advancing about 1/3 there, Tom. I'm with you. Just how compromised is the Federal Reserve Chairman, who is clearly looking for a second term at the top of the central bank in America?
Stephen Stanley, Amherst Pierpont, always good. Steve Stanley absolutely nailed it, that what he cannot do today is go down there and say remain calm. That's not going to happen.
That's the monetary policy side of things. Lisa, we've got to talk about the fiscal side as well. Things are coming together once again.
$3.5 trillion proposal from Democrats that they have agreed upon. Will they get it through, and will it matter enough to boost some of the growth prospects as we see in the bond market, people bringing back their expectations for both fiscal as well as the potential momentum in this economy, John?
Well, let's get to that bond market right now. Here's your price action this Wednesday, shaping up as follows in the equity market, 43.63. Let's call it 43.64 on the S&P 500, unchanged, advancing a couple of points. Outside of that, into the bond market, down 2 basis basis points, 139.46, a break of 140 briefly. We'll catch up with Steve Major of HSBC in just a moment. And there's euro dollar having a little look at 118 again, Lisa, 117.99.
Here in the U.S. today, we're going to be continuing with Q2 bank earnings in about an hour time. Citigroup and Wells Fargo coming out, a big focus on lending, how much it has been increasing amid consumers and companies flush with cash. Then at 8 a.m., we get the producer price index data from the month of June. How much are input prices for industrial producers going up? How much is this going to crimp a basic consumers? This K-shaped recovery that Jay Powell is likely to address, and that will be at 12 p.m. Fed Chair Jay Powell addressing the House Financial Services Committee. I'm curious how he addresses this bifurcated recovery among the haves and the have-nots, how he can argue that his policies are actually helping everybody equally and, frankly, bringing up the bottom part of the K at a time when they need the help the most, John.
If you have assets, Lisa, you're doing pretty well, aren't you? You're doing better than pretty well, and that's what's driving the gap between the two at the moment, surely.
And this is one of the conundrums for Jay Powell. How can he argue that he's actually helping the bottom part of the K when his policies are fueling the gains in markets that are really helping the top part of the K the most?
I imagine he'd bring up the counterfactual. That's something we can talk about in just a moment. Let's talk about one single name. Bank of America down about 2% in the pre-market. As Lisa points out, we'll hear from Citi, Wells Fargo in the next hour, $39.08. Tom Keene trading. Clearly where the disappointment is for some people at the moment.
They're dealing with a grosser economy, as our guest is going to deal with, John, and that's this idea, wait a minute, debt is up, Bernie Sanders wants $3 trillion, somebody else wants $1 trillion. Wait a minute, John, debt is up and yields are down.
Yeah.
My textbook didn't say that.
A break of 140. We had a break of 125 to the downside last week. Let's go straight there right now.
Yeah.
Steve Major, HSBC, Global Head of Fixed Income Research, joins us, and I'm pleased to say it's going to be with us for the next 5-10 minutes. Steve, I want to start there with a provocative question, if I may. Do you think we might have already seen the peak in this yield curve for this cycle?
Yeah, I think we saw the peak of yields at the end of March, John. And what's happened since then is the market just repricing to the reality. Rates aren't going up anytime soon. To me, I wonder what's happened to the 2% and above consensus forecast, because to me that wasn't particularly robust in the first place. So I think that there could be a scrambling of people's forecasts, as you have seen some people scramble to cover their shorts. So, pushed, if yields are going to move towards 1% or 2% through the rest of the year, I go for 1.
Steve Major, we've got an awful large audience of listeners and viewers that don't have a CFA. They didn't study Fibonacci cover to cover like you did. And they're going, wait a minute, debt up, ever higher. And as you brilliantly show, yields continue to fall. That is the arch conundrum. How can that be?
Well, first of all, the last 20 years have seen that association of higher debt and lower yield in place. Now, of course, the correlation is not causality. To go to causality, you need to think about the debt servicing channel. And that's the cash payments that have to go towards servicing the debt. The simple point, Tom, is we cannot afford higher rates. And it's very, very unlikely that we will reach the height of the last cycle. Now, that seems to me to be more important than the date of the liftoff. It's the destiny that really matters, not the departure.
Stephen, how much does this rely on an ever-easy Federal Reserve versus just the dynamics natural in the economy?
Well, look, the Fed's easy in several ways with forward guidance and the QE and the interest rate that it sets. And that sets up a bit of a trap because it's very, very difficult to unwind all of this. So the debt stock is huge globally. The interest rates are low and there is QE, etc. So it's going to take a long time. Think about a supertanker turning around the Cape of Good Hope. I mean, it looks to me it's going to take a very long time. And that speaks to today's testimony. I mean, at best, you might get an iterative shift at some point, but nothing dramatic is going to happen today. It can't.
Steve, a lot of conversation about the reaction function over at the Federal Reserve. Let's talk about the reaction function of the market participant to data. Yesterday morning got a lot of attention from a lot of people. It wasn't just the CPI print, it was how the market responded to the CPI print. It didn't last too long because, as you know, we had a messy 30-year issue a little bit later in the afternoon that changed things up. But your read, just in that period, those several hours after that inflation print, what did that tell you?
Well, I think the market is displaying a sort of Pavlovian response to all of this, in that it knows that if the probability of rates going up is to increase, as it seemed to have done at the June FOMC, then equally the probability of reaching the heights of the last cycle are also going down. So to me, the earlier they hike, the less room they have to go up. They'll have to stop earlier. And I think that that's how the market is now understanding the Fed's reaction function. They have this flexible average inflation targeting, but they've sort of chopped off the right tail by indicating that they may hike in 2023.
Steve Major, if we have a boom economy, whatever the numbers are, say Goldman Sachs is far apart, more optimistic than Capital Economics, which is more cautious, HSBC doing their own work as well. If we have a truly boom economy, can yields go up with a boom GDP and everyone remains happy?
Very unlikely that yields are going to go up, even with strong growth. If you get a 6% growth this year, you have to weigh it against the -2 from last year, so the average is +2. And look, as your show has been pointing out, real yields have been falling because they are the shock absorber that comes through. Nominal yields are being controlled. If inflation expectations and risk premia rise, the real yield can only go down. That's all that's happening.
Stephen, if you see that bond yields can remain low while this is a boom economy, does that mean that bonds have lost their signaling power, that they don't have the same kind of predictive view on the economy that they've traditionally had?
Yeah, that's a deeply involved, complex question. And I would say that when yields were down at 50 basis points last year, they lost a lot of that signaling, and also they lost the diversification benefit. But when we're at 140 or so, then there are investors who will buy long bonds. Long bonds anywhere near 2% offer ballast in a portfolio. So in terms of signaling, I think maybe people are over-interpreting what the yield and the yield curve means, because look, we've had a decade or more of QE and unconventional monetary policy. Well, of course, some of the stuff from the 70s and 80s, that doesn't really apply to today's economy and bond market.
So Steve, just a final question from me, if I may. You and I have known each other a long, long time, and I know that you've been right more than you've been wrong on this bond market. Someone just reached out to me and said exactly that, and they asked the question, what would it take for the 2% crowd to be right? What would it take ultimately for you to be wrong and the 2% crowd to be right? What do you think would need to happen?
Well, there needs to be something more durable on the employment and wages side. And I think that this is where the Fed is very inclusive. And in answering the questions, I'm sure that Chair Powell will point to that. The Fed is helping ordinary people by getting them back to work. We're a long way from seeing durable increases in wages. That might change the inflation outlook. So I would put that as one of the risks. I guess you could have personnel changes that we're not predicting in the next year or so. So, you know, personnel changes at the Fed. I'm not really sure how problematic that will be. But, you know, the point is there are always tail risks to the forecast, but we're trying to take that into account. There's also a risk that yields go much lower, by the way.
Steve Major on the bond market. Steve, just in terms of personnel changes, just quickly, the coaching staff of the English football team, do we need some changes there too? Do we need to make a bit of an adjustment there?
There's been success. We got to the final. Let's think about the positives, John.
I'm happy to do the positives. I just didn't know if you would do that after talking about the bond market so negatively for so long. And what's happening with the broader economy. Steve, it's good to see you. It's good to catch up, as always. HSBC Global Head of Fixed Income Research on this bond market. Always fantastic to catch up with Steve Major, Tom, and it always gets such a fantastic reception too, because you get a ton of pushback every time Steve comes out with a note. And then Steve sits there, and then ultimately yields go his way, Tom, and that's what's been happening in the last couple of months once again.
We've seen this, whether it's Steve Major or David Rosenberger and the good Gary Schilling as well, and you see it as Mr. Major was speaking to us, John Lawrence Fink over at BlackRock, really re-emphasizing his view of it's not transitory inflation. And John, you can set up this tension, this great debate of 2021, is Stephen Major and David Rosenberg on one side saying you're out of your minds, and some people—
Hello, traders. Good to see you all through our different platforms. I'm going to place an order to sell short Japanese yen. The price I'm looking to sell, 110,490. So if you're looking to trade Japanese yen, and if you want to copy my trade, please do so. I'm placing an order to sell short at 110,490. Okay? And I'll speak to you later after we will get filled with this order. For our strategy, you can go to companyeyes.co.uk and you can get the strategy. I'll speak to you later.
Skate through the system and overwhelm the recovery. Tom, that's the important argument to have.
Well, that is, and you know, that's the arch debate. Will it derail this recovery even if it ebbs in GDP? And we'll find out as we move through the year.
Coming up in the next hour, Brian Levitt of Invesco, a global market strategist, and more earnings still to come. Wells Fargo, Citi on deck, 43.64 on the S&P from New York. This is Bloomberg.
Okay, guys, position open, short position on Japanese yen at 110,490. Okay, I will change to red color because we sold short this position. We open short position, yeah? So what does it mean to sell short? Anybody knows? It means we're borrowing stock or we're borrowing contract from our brokers, and we tell them, we'll give you money, let's have us this stock. As soon as we borrow from brokers, we sell this stock. What it means, we promise brokers to give back at some point this contract. So the reason to sell short and the point of it, if it will go lower, we will buy at lower level and we'll give back to broker, and broker will give us will pay us for the contract we sold him. The difference will be our profit. Okay? Stay safe.
up to Maine and had a lobster. And it's not as romantic as Lisa going to Greece.
Tom Keene says what?
You mentioned Maine and the lobsters up in Maine. Well, they can't compare to what you can see in Greece. Even better, I can't pronounce it. Astacoma carinata.
I nailed it.
It's not thera, whatever. Astacoma.
You're nailing it.
Carinata.
You're nailing it.
We're figuring out the hard stuff for you on Bloomberg Surveillance. Mornings on Bloomberg Television and Radio. Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
Joe Biden is coming to our lunch tomorrow to lead us on to getting this wonderful plan that affects American families in a so profound way, more than anything that's happened in generations. We are very proud of this plan. We know we have a long road to go.
One more big push down in D.C. That was Chuck Schumer there, Senate Majority Leader in Washington. From New York City this morning, good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Wednesday morning, and here's the price action. Up 5 on the S&P, advancing a little more than a tenth. NASDAQ 100 futures outperforming again, up 58, advancing 0.4%. Outside of that, in the bond market, still south of 140, 139.30, and down a couple of basis points on the day, Tom. And Tom, you pointed out euro dollar. We reclaim a 118 handle on euro dollar. 118.02, up 0.2%.
It's soggy. Looney goes out to a 125 handle. I'm watching this carefully. I thought Damian Sassauer's morning note on EM was really terse, John. I mean, there's some real dynamics. Even though DXY hasn't broken out to a higher level, I'm watching strong dollar trend here and as well. Right now in Washington, Emily Wilkins joins from Bloomberg Government. Emily, I got a couple questions. Let me start with lunch right now. Cole Porter, Jose Feliciano. Mr. Manchin regrets he cannot lunch today. Does Joe Manchin want to show up at Bernie Sanders' victory lap lunch today on a $3.5 trillion social infrastructure?
I'm not sure it is a victory lap lunch for Senator Bernie Sanders. Remember, he's the one who wanted $6 trillion in this package. And so he says, and this number, it's much closer to the number that Manchin put forward, $2 trillion, although it hasn't gotten quite there yet. And look, Joe Manchin, yes, he is a very moderate Democrat. He has shown his willingness to stall the Democrats' plans before. However, he has also been on the record saying that he wants to get something done. He is not opposed to this reconciliation plan. He's just sort of the person who understands his power as one of 50 senators and his ability to sort of block things. But I think there is a want to get things done in the Senate, and last night, even though we have a much, much longer way to go, is at least a first step.
Emily, get out the calendar towards a primary of 2022. Maybe it's through 21. Maybe it's January, February of next year. Is this the liberal splash before Biden gets serious and really understands he needs moderate support to maintain Democrat majority?
I mean, I think to a certain extent you are seeing that there is some concessions given to the moderate, the fact that this package was not as large as progressives did want it to be. It seems to sort of fall right in the middle. And of course, we'll see as negotiations go on exactly what does and does not make the cut for this budget resolution and then the subsequent budget reconciliation for it. I mean, yes, Tom, you're absolutely right to point out the fact that Democrats, the districts that they really have to keep are moderate districts. They are swing districts that have a lot of Republicans in them as well as Democrats. And Democrats are going to have to be cognizant as they go forward, which is why they need to get this plan done as soon as possible. They don't want it dragging into 2022 where everything suddenly becomes a political battle.
I love the language choice there, Tom. Are we implying this administration is not serious with the $3.5 trillion plan? I hope they're serious about that.
They're serious about the primary season of 2022, John. That trumps all.
Yeah, and you've been on top of that since early November. Emily, I do wonder where Larry Summers fits into all of this and the timing of that meeting to have him into the White House.
I think it shows that the White House is concerned about inflation, that they are watching inflation. That is something that is certainly on their minds. They are not taking a lax approach to it. I mean, at this point, though, you still have people like Jerome Powell and Janet Yellen saying, yes, we are seeing a spike in inflation right now, but that's temporary and it's going to go back down. And it doesn't seem to have much of an impact on what the White House is supporting in terms of federal spending. I mean, Joe Biden put forward this $4 trillion infrastructure and social infrastructure plan, if you will, and that's about what Congress has come up with at this point. So there hasn't been too much of a change there. But I think that the big takeaway is just the fact that the Biden administration is taking inflation very seriously as a potential threat if it doesn't wind up going up and going down, as some in the government predict it will.
Emily, how much of a cover does President Biden have for the fact that the $3.5 trillion human infrastructure bill that was agreed upon by the Senate Budget Committee is pretty much dead on arrival, at least according to Terry Hines? He puts this at about a 30% chance of getting through. He says it's not Senate Democrats more broadly, and it seems like he has some company among analysts.
Well, let's be clear, Lisa, this has a long way to go. Yes, hitting a top line number, getting an agreement is a next step. And there are some people who are pointing out that, progressive like Bernie Sanders signing on to this bill is a potentially positive thing in the favor of getting something done. But we still have a long way to go. We have a lot of details that we don't know about this resolution that have not yet come out. And then we have to fill in the details. I mean, the budget resolution that we're talking about here, that's only sort of a skeleton outline of what's going to be in the budget reconciliation. There are time considerations, there are cost considerations, and really Democrats, every individual one has so much power. If something is in the bill or isn't in the bill and they're not happy with that, they really have the ability to pull the brakes and hold things up. So we do have then sort of the next step being taken here, but there is a long, long road ahead to actually get to the point where something will be passed.
Emily, just quickly, Chairman Powell testimony a little bit later this afternoon, midday, 12 Eastern. A lot of people coming on this program talking about an audition for a second term at the Federal Reserve. From your perspective, from the people you speak to, how are they characterizing this testimony today?
I mean, this is a testimony where he's absolutely going to be asked about inflation, about the future of the economy, and it's coming at a point where our economy's been in this really unique position of trying to come out of not an economic depression, but a pandemic. And so lots of pressure on Powell today, lots of people who are going to be watching him and watching what his answers are and sort of how he represents the Fed at this really critical point in our economy.
Emily Wilkins of Bloomberg Government down in Washington. Emily, thank you. Chairman Powell, what are we, Tom? 4 hours and 35 minutes away from testimony from the chairman of the U.S. Central Bank.
He's going to talk about inflation. He's going to talk about all the different parts of finance and the Fed. John, what he's mostly going to talk about is the people of America. He has had a social message. It's one of the hallmarks of his tenure. He's going to emphasize that today to politicians who want to hear a social message.
That's his objective. We need to talk about whether he has the tools to meet it, don't we? Shouldn't that be really the focus of the conversation at the moment? They always come out with these objectives, and I think they're very worthy, virtuous objectives. Of course they are.
You're going to get me in trouble.
No, of course they are. But do you think these policies that they have, Lisa, can achieve
I'll have a Tang
those
mimosa.
goals?
Lisa, you answer that.
I think that it's going to be interesting exactly to that point whether Jay Powell really bangs the table on more fiscal stimulus at a time when it is so controversial and politicized. Because we came into the year expecting so much fiscal spending. He was talking about the need for it. Now you have an economy that's going and you have less support for actual fiscal spending. How much is he going to say that that's necessary still to get the economy going and even out that K-shaped recovery, John?
Very diplomatic. Lisa Abramowitz alongside Tom
He
Keene.
did
Doesn't
better
want to
than
go
I did.
Chairman Powell coming up a little bit later on this afternoon. Full coverage on TV and radio with the chairman testifying on Capitol Hill at 12 Eastern. 43.66 on the S&P. Equity futures positive, a little more than 1/10%. A bid back into the bond market after a messy second half to yesterday's session. Yields back in a couple of basis points. We break 140 this time to the downside, 139.13, and we reclaim a 118 handle on euro dollar, 118.02, positive 0.2%. Heard on radio, seen on TV. This is Bloomberg Surveillance.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
From New York City for our audience worldwide on TV and radio, good morning. Here's the Wednesday morning price action. Equity futures 43.65 on the S&P 500, positive about 0.1%. On the Nasdaq 100, positive about 1/3. On the Russell, the small caps up by 0.28%. It's the Nasdaq 100 versus the Russell that I want to talk about, and thank you to so many of you that wrote in about this. Switch up the board and get to the Nasdaq 100 and a Russell. This is a story right now. The year-to-date performance, 13.88% into positive territory for the Nasdaq. For the Russell, 13.37%. We now have a bit of outperformance for big tech, and the pivotal part of this year for this story was March. March 8th is when the Nasdaq 100 bottomed. March 15th is when the Russell topped. And since March 8th, the Nasdaq 100 has rallied by more than 20% off that bottom. And it's the why that we need to get into. The why comes down to growth and this cyclical recovery, and it comes down to this bond market too. Switch up the board and get to bonds. 2s, 5s, 10s, 30s. This yield curve topped out at the end of March. Nominal yields topped out at the end of March. And it's what's going to happen with yields now that holds the key to that battle between small caps and big tech in America. And this is where we are at the moment. 24, 25 basis points on 2s. On 10s, 139. On 30s, a little more than 2%. And Tom, I think we've got to be laser focused on this debate right now because big tech is starting to win. And big tech is starting to win because of what's happening with interest rates again. We topped out at the top of March, at the end of March, at around about 174. We're back down to 139.13. And this is a simple one. If you believe that the Federal Reserve will step in and choke off growth, and growth starts to become scarcer than you thought it would be, what do you want to buy? You want to buy growth equities, Tom. And the Nasdaq 100 has been the winner recently.
And how many people have been on board, as we were told 6, 8, 9 months ago, that tech was so 2019. We'll have to see. We'll get to that in a moment with a really important guest.
And this can go the other way. Of course, this can change. You look at that Bank of America Fund Manager survey that came out yesterday. The cyclical boom has topped. You can have the contrarian view and go the other way. I just think this is the one to watch. It's the bond market that really holds the keys to what's going to happen in that equity market debate. That's the broader story. Let's get you some movers. Here's Romain.
Hey, good morning, John. Of course, most of the movers today, they do center around earnings. We did get those Bank of America earnings. That stock is lower here in the pre-market. Similar story to what we saw yesterday with regards to JP Morgan and Goldman Sachs. Of course, the release of a lot of those reserves, that helped to drive a top-line beat here. But when you look under the hood, you're seeing a shortfall here with regards to fixed income trading, really trading revenue overall coming in a little bit light. Meanwhile, expenses coming in a little bit hotter than what the street was expecting. Overall, net interest income sort of in line with estimates, but I think the street was looking for something a little bit higher here. Those shares now down about 2%. We're still awaiting Wells Fargo as well as Citigroup. Both of those names are lower here in the pre-market as well. We did get earnings out of BlackRock, of course, the world's largest money manager. Those also disappointed. $9.5 billion in inflows. That's a record. That would be phenomenal. The problem is the street was looking for a little bit more of a net inflow in the quarter. In fact, that came up probably close to, I believe, about $30 billion short of what the street was looking for, and a drop actually year over year from what we saw in the year ago period here. So keep an eye on that space. BlackRock shares down 1.4%. We also got earnings here out of the airlines starting to trickle in. Delta Airlines are reporting now. Those earnings actually were really good. They came in above expectations. In fact, the total revenue around $7.1 billion. That's about $1 billion more than what the street was looking for. Here's the bad news. The problem is that when you compare these results For 2021 to the pre-COVID 2019 period, you're still tracking 30 to 35% below what these companies were doing back then. That's with regards to revenue, load factors, even costs. Everything in there is pretty much tracking below what we had pre-pandemic. American Airlines came out last night and pre-announced their earnings, and you saw something similar, basically about 30 to 35%. Finally, just to keep an eye here on Apple, those shares were at a record high yesterday. They are moving higher here in the pre-market, up about 2% here. Some very, very bullish commentary ahead of the company's earnings in the coming weeks here. The idea here that that next cycle of iPhones will be a little bit stronger than what the street was expected. A lot of the Apple suppliers also moving higher, including Skyworks, up 2% here this morning.
Roman Bostic, thank you so much. And I note Apple just moments ago breaking out to new highs. You really wonder when we're going to get X trillion on Apple, well above 148 right now with a good morning here. Jim Suva over at Citigroup lifts, getting up to many analysts up to a 170, 180 statistic on Apple. That will come later this month. This is the most important interview of the day if you're considering trend in the market. The late Martin Zweig said the trend is your friend. Michael O'Rourke, there it is. Thank you, Lisa, for helping me with that. Michael O'Rourke of Jones Trading would suggest very much so that it is about trend. He's a chartered market technician with decades of experience. Michael, you and I have never seen the concentration of this market. You and I have never seen the tech focus that we have. Can you do trend analysis of the stock market given the absolute original breadth that we see now?
Well, you can, Tom, but it's interesting. It's very reminiscent of that 1999-2000 period where you had the four horsemen of the NASDAQ driving, the day-to-day trading. Now we see it concentrate under FAMG, and then you can add Tesla in there. And you see a handful of stocks driving this tape. And that all ties into that trade that John was talking about earlier with this growth versus value swap between the NASDAQ 100 and the Russell 2000. So you just have to keep an eye on those names because they seem to be driving everything these days.
Mike, let's go to the quote. It came from Bank of America in their fund manager survey yesterday. The cyclical boom has peaked. Quote, investors much less bullish on growth, profits and yield curve steepening. We have unwound junk over quality, small over large, value over growth trades back to October 2020 levels. Do you want to lean the other way now, Mike? Or is this the trend you want to stick with?
I do want to lean the other way here. I think yesterday's trading was a great example. We had that very hot inflationary CPI number, and the market barely reacted. And as you noted earlier, the 10-year yield peaked just below 1.8% back in March, and now we're down around 1.35, 1.4%. And then the market didn't react until that 30-year Treasury auction at 1 p.m. yesterday, 4.5 hours later. And when that auction was weak and the flows weren't there, that cued the Treasury market, and it also, which in turn cued the equity market. And what happened? We saw the growth names that had been rallying all day reverse, and we even saw the banks that were primarily down on earnings get a little bit of a lift from 1 p.m. on because Treasury yields started to rise. So I think that the Treasury trade, that squeeze, that rally that's happening here, the push yield down to 1.3%, is probably coming to a close, and we still have a lot of inflation data ahead of us, and the economic recovery is on track.
Well, let's war game this just a little bit, Mike. 10's right now at 139. We had Steve Major, respected fixed income researcher of HSBC, a little bit on the program a little bit earlier, about 25, 30 minutes ago. He said the cyclical peak might be in. He said that yield curve peak might be in. Now, Mike, if that's the case, if we've seen a peak in the yield curve, what would it mean for the conversation you and I are having?
Yeah, if we've seen a peak in the yield curve, for sure, it would mean that value names are going to remain under pressure. Growth names are going to be in favor. But again, I still think if you think about the economic environment, I would say we're on the cusp of a structural shift here. We're seeing the Biden administration taking a strong stance versus China, stronger than the Trump administration did. And obviously, China's entry into the WTO in 2001 led to a globalization boom that drove, obviously, corporate profits and lower consumer prices. And I think we could be on the cusp of a different economic environment where we do need to be a little more careful about inflation. And it's not going to look as clean and easy as it's been the past 2 decades.
Mike, this is an argument a lot of people make that basically if you take a look at the deglobalization, that will lead to higher inflation, kind of reversing the lower inflation that was spurred by globalization. If this is the trend and the Biden administration's moves do take hold, what are the equity plays that are best for that kind of environment?
So yes, it gets very tricky there because you want to be in those material names. I do like the banks in that environment because I think you're going to see higher interest rates and I think you're going to see that yield curve steepen. But you're looking for more, more of those nominal plays that are going to benefit from rising prices and those businesses that have pricing power that aren't going to see their margins as squeezed. And then on the flip side, the guys who are going to get hurt are the guys who've been basically benefited from globalization through offshoring and be able to do, a lot of their production in Asia. And like I said, it's going to look very different than what the past 2 decades have looked like if this is successful. Obviously, it's very early stages.
Mike, just quickly, conviction trade now for the rest of this year. What is it?
It's funny. We have the bank earnings coming out, and I know the market's not thrilled about them. I think the banks are the one place I want to be. I think that yield curve is going to work in your favor in the future. You are going to have things like tapering and tighter monetary policy down the line, so that's still ahead of you. And while these earnings are unimpressive, they're not bad, and it just so happens that 2020 was a very good year for the banks from an earnings perspective. Yep. They did have to reserve a lot of those profits, but once business, the trend of business settles in, I think it's going to be good for the banks.
Mike, smart. It's been way too long. Good to see you. Mike O'Rourke there, Jones Trading Chief Market Strategist. Like in the banks, Citi, Wells Fargo coming up in around about 20 minutes' time, Lisa. Talking of the numbers, they weren't great, they weren't bad. We had record numbers for the quarter from JP Morgan and the investment bank. And this is where the bar's at for these names now. Record profits sometimes, and it just doesn't get it done for this market.
Yeah, and if you look at just a pure cash flow basis, they're offering a higher yield on an earnings adjusted basis than most junk bonds are, if you take a look at that. So it really could potentially broaden out the potential investor. However, it is a faith-based investment that the yield curve is going to steepen and that those loans are going to pick up. And you do wonder, is there going to be this structural change that could spur inflation that people really are not seeing right now?
Behind every bullish banks call, Tom, is a conviction call on the yield curve. Yeah. It's hard to have some conviction and confidence on the direction of this yield curve right now.
I don't buy it for a minute. I think it's just hugely flexible here based on GDP. John, one program note, extremely important to understand, and this has come up with compliance. I just need to make clear, Bloomberg surveillance is Duke-free each and every day.
Okay, do you want to explain the relevance of that?
Well, this is Duke, and this is a small school down in North Carolina.
Thank you, Tom.
And it was unclear as of 2 days ago. We are Duke-free each and every day.
I'm familiar with the geography. Thank you.
You are very good. I'm not.
Super Abbott. Jonathan Ferro. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. President Biden says it's a national imperative for Congress to pass voting rights legislation to counter state laws passed by Republicans. The president called the efforts to curb ballot access, quote, election subversion. The latest flashpoint is in Texas. Most of the Democratic representatives in the state house left for Washington in order to prevent the Republican majority from passing new voting limits. Treasury Secretary Janet Yellen and Federal Reserve Chair Jerome Powell will discuss the financial risks of the hot housing market. They'll meet with fellow regulators on Friday. The goal, to make sure the U.S. is not vulnerable to a crisis like the one it suffered more than a dozen years ago. And Brazil's President Jair Bolsonaro reportedly has been hospitalized. According to CNN Brazil, he was admitted to the Armed Forces Hospital in Brazil for tests. There's no other information. Kathy Wood's ARK Investment Management has been selling Chinese tech stocks. China's weighting in Wood's flagship ARK Innovation ETF, it's plunged to less than 1%. That's from 8% as recently as February. Wood says there's been a valuation reset in Chinese tech stocks. Beijing has intensified its recent crackdown on the sector. And Apple and Goldman Sachs are teaming up for a buy now, pay later plan. It would let consumers pay for any Apple Pay purchase in installments over time. Goldman would be the lender. The firm has been Apple's partner for the Apple Card credit card since 2019. Global news 24 hours a day on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there has been a partnership between governments and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada is going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
The next couple of weeks might be hard until we get to summer holidays, and then we should see a clear situation which should be alleviating. We should even recover some of the lost volume. Next year should be better, and I would say within 2 years' time we should have enough capacity for the whole industry again.
Transitory is 2 years now, just
Give you that one.
Thank you. Glad
Thank
to know
you.
that.
All right, cheers, Tom.
Good.
Herbert Diess there, the
Glad I showed up
VW CEO from New York City on TV and radio. Bank earnings in focus, City at the top of the hour, Wells Fargo out now. Here are some of the numbers, Tom. Let's start with the net interest income. That comes in at 8.8 billion, a little shy of the estimate, 8.97 billion. Yeah. The CEO giving you some guidance there on loan growth. Headwinds of tepid loan demand also remained. Just a couple of headlines, but I think that last one, Tom, that seems to be the issue right now for some of these banks.
It is, and they're going to cut costs. Wells Fargo there with an efficiency ratio, which tells you that they're really cutting costs. We're going to do this in 11 minutes with Sonali Basak with Citigroup as well. We shift gears here. We go energy, we go commodities, we go cyclical. David Wilson with a stock chart. Interesting on commodities right now, right?
Yeah, absolutely. And what we're talking about here is relative valuation when you consider projected earnings across developed markets. So looking at the MSCI World Energy and Metals and Mining Indexes. And it's a pair of indicators that Andrew Lapthorne over at Societe Generale cited in his latest note. So what's interesting, if you go through our numbers and look at 12 months, he went 18 months out.
What's he see?
But just the 12-month figures alone, which the chart focuses on, you're seeing the energy stocks a third cheaper than the MSCI
But
World.
I thought energy stocks have done a moonshot.
Well, yeah. And what's happened is we've seen oil prices go up. We see earnings estimates go up. And as a result, I mean, the stocks get cheaper on a price to earnings basis when you look forward. So, that's what's happening to that group in relative terms. And then when you go through the metals and mining stocks, you're talking about a discount of as much as 54%. Now, in terms of, history, for the energy stocks, it's the biggest discount since 2008. And we have data on the metals and mining group going back to 2010. It's the lowest ever. So, possibly 2008 as well. It just goes to show you how cheap these companies have become in relative terms. And, Lapthorne likes what he sees in terms of being able to buy here.
Dave, let's rip up the script a bit because we are getting bank earnings with Wells Fargo just crossing the tape. But yes, they were disappointing, but you're seeing shares down 0.9% in pre-market trading. Not anything to write home about necessarily relative to some of the other moves, at least not yet. Can we talk about positioning heading into these earnings? We're talking about gains and how cheap some people see the metals and mining industry as. How has positioning been coming into these earnings with the banking stocks in particular, given the losses that we've seen over the past few weeks?
Well, I mean, it may be notable that if you were to go through all three banks that are reporting today, I mean, their shares all fell yesterday, along with those of JP Morgan Chase and Goldman Sachs. So it's clear that people are looking for whatever weakness they see in the quarterly results and focusing on it, whether it's loan growth, whether it's bond trading, whether it's costs, whatever it is. So, and that may well be a theme that plays out throughout the entire earnings season because, we know that profits are going to be well above what they were a year ago just because of the pandemic. And, they've been beating analyst estimates handily already and, more to come on that score, no doubt. So, it becomes a matter of what are the weak spots and how do companies sort of see things moving forward?
There's also a question of how much is under the control of bank management. Yes, we talked about Wells Fargo cutting costs dramatically, and we hear that as a theme and a desire across the board. However, it ultimately comes down to interest rates, to net interest margins, which are not that great considering how low yields are. Wells Fargo is a perfect example of that given their loan book. How much have bank stocks been trading basically in tandem with the yield curve, with 10-year yields in general?
Well, there has been that relationship, no question. If you look at the last few months, there are a number of charts that have kind of pointed to that. And beyond it, it's a matter of, what does the economy look like going forward? I mean, we've seen, shall we say, the recovery trade kind of buckle a bit at this point. Some investors going, for dividends. And certainly with energy stocks, you're talking about whether you look at MSCI World or even the S&P 500, the highest dividends among the main groups. And metals and mining dividends competitive as well with a potential for increases as their business progresses.
David, thanks so much. Greatly appreciate that. What I would look at here, John, is Ben Laidler right for 3 years straight. He said it's a double-digit 2021. He may get that.
You got one already right now if we closed it, Tom, it's been pretty good for this market. Mentioning some of the sectors, take a look at the airlines. I've seen a couple of downgrades come through this week from the likes of Evercore and others on United Airlines. Tom, that stock is down about a fifth from the highs of March, and it's not just the airlines. Take Carnival Cruises. That stock is down about a quarter from the June highs. These are sectors of this economy that are struggling. This is not where we thought we would be 12 months ago, 12 months out. We thought that travel, international travel specifically, would be far wider open than it is right now.
Yeah, I looked for the load factor on Delta Airlines today. It's improved a little bit, but just a little bit. John, what I would say more than anything is you got speculation sectors, volatile sectors that go up and down, but the meat of this great bull market of 8, 9, 10 years continues, and you see it this morning. We're red and green, and all of a sudden, across the indices, we're green on the screen.
NASDAQ 100 up 57, Lisa, advancing about 0.4%.
When you talk about airlines, I do wonder how much we really haven't seen the actual reopening in the economy. And I think about how the Bank of America chief financial officer is saying that it's back to work, back to the office in September, kind of echoing some of the other comments. How much will the in-person experience, business travel picking back up, give a renewed boost? But on the flip side, how much can they increase capacity and hire enough people, John, in order to meet that demand?
We're not going to get a clean read on this economy until the back end of this year, Q4. That's pretty clear. You've got to wait until September. You've got to wait until September for additional unemployment insurance to end. You've got to wait for September for the kids to go back to school in this country and see what happens with childcare.
Hallelujah.
There's a child tax credit that goes into the mix as well. It's going to be interesting to see what happens with that and what that means for the participation rate too. The end of the year, and I go back to this because we had an interview with the Vice Chair of the Federal Reserve, Rich Clarida, that I was reminded of recently. And Tom, that's the only real clarity we have on what they're waiting for on the calendar. And he said, it's the end of the year. When we asked him a very basic question, transitory, and all that good stuff, transitory, how will you know if you're wrong? And when will you know if you're wrong? And he was talking about the end of the year. And it's going to take until the end of the year to get a clean read on the underlying economy and what it means for policymakers.
All of the mumbo jumbo, and I think we'll see this today with Chairman Powell, John, is they're just simply data dependent. And they have restated that they are ever more data dependent given a further ex post view.
But that data is highly influenced still by the policy decisions of the last 12 months. And the numbers that we see from the banks, and Lisa, I think this is what you're getting at here, the numbers that we still see from these banks are still highly distorted by what happened 12 months ago because the consumer has come out of this with a massive cash buffer. They don't need the loans. And all we wanted today, yesterday, tomorrow is some guidance on loan demand, and they can't give us that still. All they can say is it might get better in the future.
Well, so without that guidance, what do you bet on? If you bet on low interest rates, can you just count on those dividends that Dave Wilson was just talking about?
On that, David George, Robert W. Baird, Senior Research Analyst on the U.S. banks. Citigroup coming up next from New York for our audience worldwide. Heard on radio, seen on TV. This is Bloomberg Surveillance.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Silicon Valley.
This is the global center for high technology and innovation. What happens when big tech goes unchecked?
Too much power.
They're more powerful economically, socially, politically.
Is big tech going bad?
It's all about balance.
They're not bad because they're big.
I don't think big by itself is bad.
They're bad if they violate the law and if they hurt consumers.
Bloomberg Red Lines, U.S. and big tech. Friday on Bloomberg Television and Bloomberg Quick Take.
When you look ahead to the next few quarters, we very much believe the economy will be still growing well above trend.
Americans are more flush with cash. They didn't need to borrow, but that wears off. Some of the strength in the consumer that we're seeing in the credit card spending data, that's going to start to shift to the business sector.
This is more than transitory. So far, the market is believing
we cannot afford higher rates, and it's very, very unlikely that we will reach the height of the last cycle.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowitz, and Tom Keene on radio and television, a simulcast. For surveillance, it's a strategy refresh. John, for Citigroup, it's a strategy refresh.
Making progress on that strategy refresh over at Citi, not here, Tom. Let's talk about these numbers out of Citi right now. Investment banking revenue a little bit lighter, $1.58 billion. The estimate there comes in $1.63 billion, so a little shy, a little lower of the estimate there. So a miss on investment banking, a miss on fixed income sales and trading revenue too. That comes in at $3.21 billion. The estimate $3.64 billion. The forward look, Tom, the language is constructive, optimistic about the momentum ahead. The pace of the global recovery is exceeding earlier views, markedly increased spending on credit. So the numbers, downside surprise, a little shy of estimates for the investment bank and for trading revenue, for fixed income trading revenue specifically. The forward look, as you might expect, constructive, Tom.
John, I'm going to look at a comparative book value. This off the Bloomberg BQ screen. Citigroup under 1 on a book value ratio. JP Morgan 1.89. John, that is the distance Citigroup has to make up.
Equity sales and trading revenue, Tom, comes in a little north of the estimate. That's in at $1.06 billion. Slight beat there, the estimate $916.5 million. I think the investment banking number, Tom, that's going to be a disappointment because we saw some strength elsewhere on Wall Street. And Shanali's been talking over the last 24 hours about who got market share. Did the pie get bigger or is this market share? Clearly the pie got bigger. Fees were huge in the first half of this year, but clearly a miss there as well for Citi that will go down as somewhat as a disappointment this morning, Tom.
Lisa, I'm going to say there's a Fraser tinge here. These headlines speak differently than the headlines we saw from Mr. Corbett.
They do, and it's interesting to me to see that this is her first year at the helm, and you can see that they are lagging behind in some areas, but the shares are not responding to that. I just want to point out one aspect. Citi predicted tech spending would contribute to an increase in total costs as much as 3% this year. They want to spend, they want to invest, and I wonder how much, Tom, this sort of speaks to your discussion about the future of fintech and, frankly, a more optimistic view for Citigroup.
Shanali Basak with us, of course, here, our Wall Street correspondent. Shanali, real simple, in all the calls you make and the ballet you go through, is Citigroup part of the big banks, or are they an also-ran?
It's a great question because we know they're going through those regulatory issues. We know that this is Jane Fraser's first full quarter as CEO of the company. They're reshaping that consumer business, but in investment banking, I think is one of the most important ones. In fixed income trading, they are the number 2 by revenue, right? Also fell short of expectations. In advisory, we knew that they were behind Bank of America in market share just by where the global league table sat. At the same time as these numbers were coming out, CFO of Bank of America, Paul D'Onofrio, was speaking to the media, and what he was saying was they were seeing market share gains, especially in those middle market businesses across America. These deals are somewhat smaller than we've seen in previous boom times for deals. That market share question, again, is going to continue to be a big story this year as we see divergence among businesses on Wall Street.
Stock dancing around in the pre-market, Shanali, as you might expect. We're basically unchanged on Citi. Let's talk about the forward look. Just a little bit of a guide from Bank of America, some constructive language from Citi, all the kind of language you might expect. Shanali, what's your read on that, the forward look through the rest of this year?
You and I have been talking about this a lot, that Citigroup is cheaper relative to its peers. It's trading below its book value. And so is it a turnaround story as they get through these regulatory issues, as they try to build more market share in Jane Fraser's early days as CEO of the company at that investment bank? Can they maintain that FICC wallet as high as it is? These are all questions that are outstanding for Citigroup. The cost question is interesting because you look over at Bank of America and Wells Fargo, both of their headcounts for the quarter are down on the quarter. Yet at Bank of America, the costs are still higher for compensation expenses and other expenses. So how is Citigroup going to be competitive? At the end of the day, it comes down to just not only flexibility, but also what they are able to pay their bankers.
And when you talk about flexibility, how much do you expect Fraser to discuss the work from home type of aspect, especially as Bank of America CFO comes out and says, you're all back to the office come September?
Yeah, it's a great question because we heard David Solomon just yesterday over at Goldman Sachs saying 50% of his people are coming back into the offices. I spoke to one of Goldman's top bankers and he said that return to office is a key thing that helps them gain market share at the end of the day. Will Jane Fraser defend her strategy about flexibility when it comes to retaining talent? They said it was a competitive advantage for them, but then we'll also need to see those hiring plans. Are we going to see their pipeline of senior bankers grow in the coming months?
Shanali, final word. Pretty much all the banks have delivered now. Morgan Stanley coming up tomorrow. What are you looking for?
The wealth fees, John. Absolutely. They want to grow their lending book, and that is the one place in loans that is growing on Wall Street. That, and are they able to maintain their wallet in equities where we know that Goldman Sachs and JP Morgan have been nipping at their heels for many, many quarters here and showing some gains.
Shanali Basak there, Bloomberg Wall Street correspondent. Shanali, thank you. Let's bring in David George, Robert W. Baird, Senior Research Analyst for US Banks. David, your first take on the numbers, please.
I think overall, John, it's great to be here. I think the numbers overall were pretty good and continue to reflect an improving economy, and that's evident in activity levels as well as a very strong credit quality really across the board.
So, David, when we take a look at these numbers, one thing that has pocked all of bank earnings has been the lack of loan growth. And I'm wondering, to the extent that there is loan growth, it has come among the wealthier individuals. How much is that sort of key point here, that wealthier individuals are borrowing versus their assets so that they don't have to liquidate portfolios that are currently invested in equity markets?
Yeah, we've seen, it's a great point. We've seen fairly significant growth, Lisa, in what I would call securities-based loans. And as you refer to, wealthy individuals basically using their stock portfolios and wealth portfolios to use debt for other purposes, could be to buy a home or other measures. So we're also seeing a pickup in credit card growth. So JP Morgan yesterday had 8% card growth, and we've seen the card stocks react pretty positively. But other than that, loan demand continues to be pretty soft.
David George, I want you to parachute in McKinsey or Bain or the other great thinkers out 5 years. Which of these banks is best positioned for 5 years out?
I really think that the industry, Tom, I'm trying not to make any big headlines. I think that the industry in many ways is as in good a shape as it's ever been, particularly from a risk perspective. I think that the regulatory framework of the CCAR has made many of these companies, and I say this as a positive, very utility-like in nature with respect to the predictability of their revenues, predictability of their earnings, and the general lower risk perspective of these.
Okay, traders, are you ready to play stop and profit for Japanese yen? Okay, guys. As you can see, it moved sharply in our advantage, and I'm going to place stop on profit at 110 390. Okay, 110 390. It will give us 1,000 pounds in profit. Okay, guys. So if we copied the trade that we made, what time is it now? It's 1 o'clock. Let's say 1 hour ago. You already in profit. Well done. So because 1 pip equals 100 pounds, 10 pips, 49.39, it will be 10 pips, gives us 1,000 pounds. Okay, guys, stay cool, stay, don't try to sell position, stay with me, and we will see what's going to happen next. If it will move lower, we will put lower our stop on profit. Okay, I'll speak to you later.
Resolved, but in the meantime, I think it's going to be pretty slow going.
David, can you build on this idea of deposits increasing at such a quick pace, given that people have been expending so much spending? Is there an incoherence here in the fact that people are still stashing so much away in their savings?
Well, it's a great question. I think part of it is just simply the government crowding out the banks. A lot of this deposit growth is simply government stimulus money finding its way into bank accounts, and I don't really see that changing much in the near term. Now, I think in 2022 we should see loan growth start to get better, but it's not going to be nearly as strong a growth as maybe what we've gotten accustomed to over the last 20 to 25 years.
Do we have to give them the toaster to take our deposits now? Is that the future?
That's actually, John, that's a really, really sophisticated question.
Are we giving
Seriously.
Are we giving them the toaster? Do we have to pay
The
a lot more for
toaster's
the
called,
accounts?
John, a toaster. David, this is really important, John. David, Affirm and Square, they're the toaster. Is Affirm and those people changing the debate? What's the fear level on modern fintech for these bankers?
Yeah, it's a good question. I think that the industry, these behemoth banks, continue to be infringed upon really from all angles. And you mentioned obviously some of the fintech companies of the Firm and the like, and I think that's going to continue. Where banks really differentiate themselves, from my perspective, as a longtime bank analyst, seeing a lot of different cycles, is their ability to underwrite risk as well as their funding. They've got all of the same products that these fintech monoline companies, but also have, we think, much more sophisticated credit modeling capability, scale, and funding.
David, love catching up with you in earnings season. It's good to see you. David
Likewise,
George there,
thank
Robert
you.
W. Baird, Senior Research Analyst on the US Banks. Citigroup slightly positive, up 0.2 of 1%.
John, you'd probably get one of those Smeg toasters, one of those fancy
I've got one of those
Italian
Smeg toasters.
Of course you do.
The Dolce & Gabbana toaster.
I haven't got one of them. 43.68 on the S&P from New York. This is Bloomberg.
With the first one news, I'm Rich Kigup. The United Arab Emirates has resolved its standoff with the OPEC Plus coalition. A delegate tells Bloomberg there's a compromise deal that will give the UAE a new oil output quota. Last week, OPEC and its allies were forced to abandon a tentative deal to boost oil production because the UAE objected. If the compromise is ratified, that could open the way to more oil being pumped. The European Union is unveiling a climate change plan to phase out fossil fuels. It will have an impact on every corner of the bloc's economy, from how people heat their homes to the cars they drive. Every industry would be forced to cut pollution by at least 55% from 1990 levels by 2030. And new combustion engine cars would be eliminated. Senate Democrats on the Budget Committee have agreed on a $3.5 trillion spending plan that would expand Medicare and provide more generous childcare benefits. The legislation would carry most of President Biden's economic agenda into law without Republican support. The agreement is a win for Budget Chairman Bernie Sanders. He had pushed for that Medicare expansion. And
And Apple is planning a big increase in iPhone shipments this year. Bloomberg's learned the company's asked its suppliers to build as many as 90 million next-generation iPhones in 2021. That's roughly a 20% increase from last year. The next iPhones will be Apple's second with 5G, a key enticement pushing users to upgrade. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Up to Maine and had a lobster. And it's not as romantic as Lisa going to Greece.
Tom Keene says what?
You mentioned Maine and the lobsters up in Maine. Well, they can't compare to what you can see in Greece. Even better, I can't pronounce it. Astacoma carinata.
I nailed it.
It's not thera, whatever. Astacoma.
You're nailing it.
Carinata.
You're nailing it.
We're figuring out the hard stuff for you on Bloomberg Surveillance. Mornings on Bloomberg Television and Radio.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Curtain will rise again.
Broadway's returning June.
If you bought tickets,
It's busted out.
you've got
all
more
over.
time here. If you want.
Commodities are up.
Keep going.
To the moon.
Beautiful.
Bloomberg Surveillance, weekday mornings on Bloomberg Television and Radio.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
We expect higher interest rates, higher loan growth, higher traditional banking revenues, higher revenues from Main Street. And when that comes, That's the next part of the story. So do not leave the U.S. bank stock show yet. It's just intermission.
Hold on to the popcorn. That's the message from Mike Mayo, Wells Fargo Securities head of U.S. large cap bank research. I think he actually had the popcorn with him, as you might expect, with Tom Keene, Lisa Bramford. I'm Jonathan Ferro. This Wednesday, here's the price action in your equity market. We're up 7. We advanced almost 0.2% on the S&P to 43.68. The Nasdaq 100 up 67, advancing 4 or 0.5% there. So there's a lift to this equity market, and it's driven by big tech over the last couple of months. Outside of that, yields are in 3 basis points. Your 10-year 138.29, and Tom, in 3 hours and 40 minutes, we'll hear from the chairman himself. Chairman Powell testimony coming up a little bit later down in Washington.
I'm certain Chairman Greenspan would allude to it, and maybe Chairman Powell will as well. It's terrible out there, folks, because tech is going to fall behind. Value and cyclical are going to win. Dow up 31%, 12 months trailing. S&P 500, good morning, John, up 37% as well. And the NASDAQ trails up 40%. Apple, a moonshot this morning. They're going to sell some more iPhones, according to Mark Gurman. Brian Levitt has 14 Apple products in his house, and he joins us this morning with Invesco and the Global Market Strategist. Brian, thank you in your research note for saying, would everybody just shut up and look at the revenue growth of growth? I mean, it's there, isn't it? How growthy are you right now?
So I am pretty growthy. And you know, what investors have to realize is there's a recovery phase of a cycle. That's when things like deep value performs well, and the really cyclical parts of the market perform well. And we're moving into an expansion, and ultimately we'll move into a slowdown. And in a slower growth environment, you know, growth stocks will outperform again. So to me, this always felt like a reversion from a very deep place up to some type of mean, but nothing structural has changed in terms of what I believe market outperformance will be.
How do you respond to the reality we lived 20, 30, 40 years ago, which is that every 8 years, 9 years, 11 years, value surges and then it goes to sleep again? Has it really changed?
No, it hasn't changed. I mean, value tends to need a catalyst, and a catalyst tends to come in the early stages of a cycle as the economy is moving to a new higher rate of growth and as policy remains very accommodative for a long period of time. So you can see value outperformance for a handful of years. But the challenge with this cycle is that everything's happening very quickly. We had a very sharp recession quick. We had a very quick recovery, and we've quickly moved into an expansion phase, and we're already seeing the yield curve flatten. So everything has accelerated in terms of the duration of it, and so it's probably a shorter value cycle than what you've seen in the past.
Well, that brings up the call of the morning then. It's from Steve Major of HSBC, who thinks we've already seen a peak in the yield curve. Brian, if we have, is that trade over?
I was listening, and I love that call. I mean, the reality is, in order to think that the 10-year rate is going meaningfully higher, you'd have to assume that the U.S. economy is moving to a new higher structural level of growth, structural level of inflation. And I know there's been a lot of hope for at least higher structural growth. I find that that story is challenged. And so while rates may move up a bit here, I mean, 125 was quite low, signaling, in my opinion, a pending Fed mistake that I don't think isn't forthcoming. You could see rates trend higher, but I don't think they're going meaningfully higher. So could 175 be the high? Certainly.
So how incoherent is this call that the value cycle still has legs, that you could still invest in things like the financials and outperform at a time when we may have already seen the peak in the yield curve?
Well, it doesn't have to be totally incoherent, because we're still coming from a very low level of rates again. So can rates trend up a bit? Sure. We think of the cycle in 4 different quadrants: recovery, where value does very well; expansion, which is where we are now. Value and growth both tend to do well, as we've seen for some of the recent months. As you move into the slowdown, that's when the value story starts to dissipate. So I don't think we're moving into a slowdown in the next couple of quarters. Will we start to move into a slowdown as we move into 2022? Absolutely. So the value cycle might have a bit more to it, but ultimately the growth stocks will be the outperformers throughout the rest of this cycle.
When we talk about inflation, you're in the transitory camp, that we're going to see inflation moderate, and that these really are pressures from the reopening trade. At what point do these pressures, these upward prices, put a crimp on the recovery itself and dampen sales, dampen people's ability and willingness to go out and spend their money?
Yeah, I mean, Jonathan told me I'm not allowed to say transitory, so I'm going to go with temporary or
You just did.
momentary.
So go ahead.
I just did.
We're
Well,
all
I was
drinking.
quoting what he told me. So, yeah, you're right. I mean, at some point, the solution to higher prices is higher prices. We've unleashed a lot of pent-up demand, and, you see it in things like hotels, and you see it in things like airline fares, but how many vacations can we all go on? At the same time, businesses are working to rebuild inventory. And so, I think that the higher prices will start to moderate some of the demand. You kind of see it in lumber prices. I mean, lumber prices are all the way back to where they were for all the hand-wringing over it because it slowed down demand once lumber prices got too high.
John, should we ask how many vacations we could go on?
We can. Do you want to do that now?
Should we? Let's not do that now. We
Let's
can
wait
do
a
that later.
second. I do wonder if the more appropriate question is a different one. Whenever you bring up the word transitory, and the reason I really don't like it is because people are arguing over different things. And Brian, the question that Mohammed Al-Aaron and others are asking is just a simple one, and I think it's a better question to ask. Do you think the push higher in prices now will overwhelm a sustainable recovery and force the Fed to come in early? I think that's really the question we've got to grapple with. And what's the answer to that?
Yeah, that is the big question. I don't believe that will happen for a variety of different reasons. So I do think that pent-up demand will start to moderate. I do think that businesses are going to be working to rebuild supplies. I do think that, the prospect of a slower growth environment is also part of, perhaps less fiscal support next year, perhaps higher taxes next year. So altogether should mean a slower growth environment that helps to ease inflationary pressures. It's not only me that sees it. You can see it in the bond market. I know that inflation break-evens backed up yesterday after the CPI report, but nonetheless, you see much higher inflation expectations over 1 year than you do over 2, 3, and 5 years. So it's a bond market that expects this to moderate as well. And to me, the bond market tends to get it right more often than any other indicator.
Brian, I think you've got a friend called Steve over in Hong Kong. It's good to see you. Brian Levitt, Invesco Global Market Strategist. Brian, thank you. Steve Mnuchin speaking to CNBC a little bit earlier this morning, saying the following: doesn't think inflation is transitory. The Fed should trim asset purchases immediately. I imagine Secretary Yellen has a different view on things if she was to give the Fed any advice this morning, Tom.
The punditry right now, John, and we're just like walking through the mud of the punditry right now. Whatever anybody's view is, it's just amazing how the punditry is heated up. John, can I point out in the growthiness, someone like Ben Laidler, up 21% per year off of his December 2018.
Not a bad call, is it?
I'm just bedazzled by all the negativity out there.
You know what we missed? How many vacations can you take? We asked the wrong person.
We did.
I think we're out of time.
Lisa,
We're running
how
out
many
of time.
can you take?
We've got 8 seconds left. Come on.
Up to the
New York
Adirondacks
City.
in Camp
On
Transitory.
radio and TV. This is Bloomberg.
Blast off. China's first manned mission in 5 years is on its way. 2 veteran astronauts and 1 newbie are making their way to Tianyi Space Station, which means heavenly harmony. They're travelling in the Shenzhou 12 spaceship, launched by a Long Mark 2F Y12 rocket.
我们一定服从命令，听从指挥，沉着冷静，精心操作，圆满完成神舟12号载人飞行任务。
The crew members will be staying at the station for 3 months. They'll be carrying out experiments, testing equipment maintenance and more.
2022年完成充电站的在轨建造，建成国家开出先时。之后，充电站将进入到应用与发展阶段。
Once completed, the space station will allow for stays of up to 6 months, just like the International Space Station. China has big ambitions for its space program. Last month, it landed a probe on Mars that carried a rover, the Zhurong. It sent 11 astronauts into space and 2 years ago sent the first spacecraft to land on the far side of the moon.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
From New York City, for our audience worldwide, live on TV and radio, alongside Tom Keene, Lisa Bravitz, I'm Jonathan Ferro. Equity futures 43.67 on the S&P 500. Testimony from Chairman Powell with the headlines. Here's Mike McKee.
Good morning, guys. Well, Chairman Powell breaks no new ground in his opening statement, offering a relatively upbeat assessment of the economic recovery while maintaining it is still too early to begin talking about cutting back on monetary policy support. The economy is on track for its strongest growth in decades, Powell says, but taking a line from the latest Fed statement adds, we continue to expect that it will be appropriate to maintain the current target range for the federal funds rate until the Fed reaches its goals of maximum sustainable employment and inflation averaging 2%, in Powell's words, for some time. While he doesn't specifically refer to yesterday's unexpectedly high CPI reading, Powell does say that inflation has increased notably and will likely remain elevated in coming months before moderating. Most inflation pressures, he says, are coming from the reopening of the economy, from base effects, and from supply chain challenges, and they should start to fade. What's important, Powell says, is that measures of inflation expectations have moved up from their pandemic lows and are in a range that the Fed considers consistent with the FOMC's longer-run inflation goal. The labor market has improved, Powell says, although minorities have yet to see significant benefits, and he predicts that, quote, job gains should be strong in coming months as public health conditions continue to improve and as some of the other pandemic-related factors currently weighing them down diminish. While substantial further progress that the Fed is looking for hasn't been achieved yet, the committee will continue to discuss when they should start tapering, Powell adds, and they will talk about it in future meetings. So not a lot of meat in there, guys, but the Fed sticking to its guns, even in the face of those higher inflation readings.
Michael McKee, with that complete report, I think we've got to go to the soap opera at hand, which is Lawrence Summers, who you and I know well, with the Biden administration yesterday and some illusion that maybe he talked to them about who would be the next Fed chairman. Would Mr. Powell be reappointed? Will you listen today, or what will you listen for today from Chairman Powell that affirms his desire to continue as chairman?
I don't think he'll get anything, Tom. I think he will be asked, and he will say what he always says: I'm focused on doing my job right now. The decision is up to the president.
All right. Meanwhile, as we were getting those headlines from Chair Powell, we also got some data on inflation. You were talking about higher inflationary reads. Well, here's some more. PPI coming in, ex-food and energy up 1% versus the survey expectation of 0.5%. You could see the final demand year over year for the PPI for producer products. You could see up 7.3%. Talk about price pressures versus the expectation for 6.7%. At what point does Jay Powell go beyond just talking about transitory and talk about the real world effects of these higher prices on consumer appetite, on the ability for people to go out and have a life?
Well, it is a tough job for the Fed chairman because they do believe that these prices are going to start to come back down, but the pipeline pressures are still there. And Republicans in particular on Capitol Hill will give him a hard time about it because Americans don't like paying higher prices. We have seen, as you were talking about earlier on the program, the decline in lumber prices, and we can hope that gasoline prices start to come down if they can reach some sort of agreement. But other prices should moderate. We can say that the PPI year over year and the core PPI year over year are at new record highs, but the month over month, Lisa, didn't reach a record because in March of 2020 it was up 72%.
Very good. Michael McKee, thank you so much. 33 miles southwest of Jackson Hole this morning. Right now, John, we got to do a data check. We got big green on the screen. NASDAQ up 0.6%. We're going to launch out to some records there perhaps today. But, John, what I really noticed is a complete deterioration of the real yield. We're not down to 10-year real yield, new big negative numbers, big lows. But there it is, John, another thrust away from where everybody wants to go.
Look, you've got to pay attention to what's happening in this bond market, Tom, at the long end on 10s and 30s. Yeah. We've just had a chairman say we got more work to do. We've just seen some data that, once again, yes, it's hot, but it's hotter than expected, far hotter than expected. CPI yesterday, PPI today, and look at what is happening with yields at the long end. A 30-year yield threatening to break below 2% again, Lisa. Yields are coming in 4 basis points on 30s. We're on almost 5 basis points now on 10s.
And the idea here is either the Federal Reserve will be forced to hike rates faster and curtail the growth more rapidly, could crimp growth. We're seeing that already with lumber prices. The reason why they're coming down, people were demanding fewer of the lumber products just simply because of the prices, or housing. You do wonder about the feedback loop and the bond market speaking loudly, John.
This conviction, Tom, that we've got more work to do in this labour market, it's born out of where we were before this pandemic. If you look at the participation rate, the employment to population ratio, there's a belief in the core of the Federal Reserve that we can get back to those numbers. We can get those data points back to where we were before this pandemic. I don't think everyone's convinced of that when it comes to participation rate in America. There are some people that believe things might have changed, and that's the debate we've got to have as the year progresses.
On balance of power, an Oklahoma official, John, the other day, they have a 4% unemployment rate, and they want to get back to the nirvana of 3.1% in Oklahoma. We will see. We've got the right guest at the right time. After all of this, Stephen Rasciuto joins us with decades of experience with a view to the American economy. Steve, I've got an arch debate on GDP right now. Goldman Sachs with some enthusiasm. Capital Economics goes the other way. Which is it? Will we have a soggy and rapid downturn from this boom economy, or will it sustain longer than we can imagine?
Well, it will continue to be above trend in 2022. Our estimate is we'll be in the 3.5% variety for 2022. But by the time we get to 2023, we're going to be back down in the 2.25% area for growth. So the reality is we're not going to be able to sustain this unless you get continued bounce of fiscal policy. And this is one of the reasons why I think the Federal Reserve is going to be late to the party as opposed to early to the party, and allow this thing to continue to run as hot as they can for as long as they can.
Steve, what do you make of the argument that the conditions we're facing at the moment could overwhelm the recovery, could actually shorten the duration of this cycle? What do you make of that?
Well, you got to understand, business cycles in a world of global excess supply are not driven by inflation. They're driven by credit quality. And when you look at the underlying credit quality matrices for the household sector, the non-financial corporate sector, or the financial sector, they're all extremely healthy, which means to me this is going to be a very, very long expansion. It may not be exceptionally robust out beyond the 2023 period, but it's going to be a very long expansion because the credit quality is going to take a very long time to erode from the high levels that we're at right now.
As the Fed pledges to remain tight, to be late to the game, as you say, who are their policies helping most right now, high or low income households?
Well, again, this is part of their problem. They're trying to create a firmer labor market environment with the intent of pulling a lot of these workers back into the labor market, getting them back employed in jobs that will continue to grow. It's a tough order for them to accomplish this. And I agree with some of the points that Jonathan was making earlier about things will be different when we come out of this on the other end of it in terms of productivity change and things of that nature. But I think the Federal Reserve, given the political conditions that we're facing, has no alternative but to let this experiment run to see if they can accomplish those goals.
Stephen, I think of the younger Stephen Whiting at Citigroup and you as having just phenomenal abilities to calculate what corporate America will do and how it folds into GDP. The fact is, what we're seeing now is corporations adapt to this crisis. Do we underestimate their ability to create revenue and to create profit down the income statement?
Well, I think they're going to surprise everybody with how much they can create profitability and earnings going down the trajectory. The one thing that I think the Fed is fighting, which is very, very difficult for them to counter, is the idea that corporate America is still very, very focused on reducing labor compensation. I think one of the things that comes out of the whole COVID recession was a real push towards reducing the amount of labor that's necessary in a lot of service-oriented jobs. And this, I think, is what makes the bar the Fed has set for itself that much harder to accomplish. And that's just going to drive the profitability of corporations as we go forward.
Steve, it's good to see you. It's always great to see you. Thanks for being with us. Steve Raschuta there, Mizuho Chief U.S. economist, on the latest data and the testimony we're set to hear from Chairman Powell in several hours' time. It's the price action in response to that, the data and how the market responds to it. Your bond market bid yields in 4 basis points. Your 10-year, a break of 140 back to 137.11. Equity's doing okay. Seems to always be the story, doesn't it, at the moment? Up a third of 1% on the S&P to 43.75. Getting back into record high territory once again. The Nasdaq 100 up almost 100 points now, up 6/7 of 1%. Helped out, no doubt, by what is happening in this bond market. So let's frame it. Prices at the factory gate are flying. Prices for the consumer are flying. There is a belief that some of this, Lisa, is temporary, that the conditions that lead to this will fade as the year grows older. The question we've got to ask, does it overwhelm the recovery? That's the big debate for this market right now, for this bond market too, with yields in 5 basis points on 10s.
And to be more nuanced, does this overwhelm the recovery for the lower income households that are going to actually probably suffer more with respect to the prices increasing, since it's a bigger proportion of their income? You do have to wonder what the bond market is saying, and I think that Tom rightly pointed out the real yield, the fact that we're seeing more than a negative 1% real yield as people see yields remaining low because of the Fed, but they do see inflation ticking higher, John.
Coming up in the next hour on Bloomberg TV, Kathy Jones, Schwab Center for Financial Research Chief Fixed Income Strategist. On this very topic, I believe Lisa heads over to radio. Tom goes on vacation for a couple of hours. He's going to be on Balance of Power with Anne-Marie Hordern a little bit later this afternoon, Tom. Looking forward to that.
Looking forward to it. It's going to be interesting.
I believe you. From New York City this morning.
3.5 trillion reasons.
Good morning. That's true. Alongside Tom Keene and Lisa Brambles, I'm Jonathan Ferro. This is Bloomberg.
With the first word news, I'm Rich Gupta. The European Union wants to impose the world's first carbon import tax. The levy would be placed on certain emissions-intensive goods produced in countries with lower environmental standards. It's part of a broader package aimed at getting the EU to phase out fossil fuels. President Biden says it's a national imperative for Congress to pass voting rights legislation to counter state laws passed by the Republicans. The president called the efforts to curb ballot access, quote, election subversion. The latest flashpoint is in Texas. Most of the Democratic representatives in the state house left for Washington in order to prevent the Republican majority from passing new voting limits. Treasury Secretary Janet Yellen and Federal Reserve Chair Jerome Powell will discuss the financial risks of the hot housing market. They'll meet with fellow regulators on Friday. The goal is to make sure the U.S. is not vulnerable to a crisis like the one it suffered more than a dozen years ago. And Nike has lost a tax battle in the European Union General Court. The athletic apparel maker lost an attempt to keep the EU from investigating its tax affairs. The issue was whether tax rulings by the Netherlands may have given Nike an unfair advantage over its competitors. In China, what could be a huge shift for the country's consumer internet, Alibaba and Tencent reportedly may open up their services to one another. That's according to Dow Jones. Beijing's recent tech crackdown makes it hard for the two companies to maintain their virtual barriers. Right now, customers can't use Tencent's payment systems to buy products on an Alibaba platform. That would change. Global news 24 hours a day on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Okay, traders, let's move further. Our stop on profit for Japanese yen, and I'm going to move to 110.340. Just right here. Okay, we have 15 pips in our favor. Well done, guys. All of you who decided to copy trade and trade with me, we made a profit already, but we're still holding position, so we will see how far we will go. Okay, Stay safe.
It's harder to ensure that American innovations are used for commercial purposes only. Countries like China don't differentiate between civilian and military in the same way. And emerging technologies, including AI applications, blur that line too. So we've got to think differently about how to protect our innovation and industries against that kind of misuse.
The Secretary of State, Antony Blinken, there talking about the path forward for state and also for emerging technology. This is the Global Emerging Technology Summit. Right now, Lisa Bramwitz and Tom Keenan, we digress to corporate management and moving forward in this pandemic. Anthony Capuano is with Marriott. The CEO, Tony Capuano, out of Cornell Hotel, has had the toughest task in management of any corporate officer in America, filling the shoes of the great Arne Sorenson. I'm going to go to Cornell Hotel and Arne Sorenson, life is service. How have you managed this tough task?
Well, first of all, thanks for having me. It's great to be back in person, in studio. I had the good fortune of working with Arne for almost a quarter of a century. I think the easiest way to manage through the grief that the Marriott family has experienced is to honor his legacy by continuing all the great work he had done and continuing the company down the path that he had set forth for us.
Cornell Hotel didn't have a course, Pandemic 101.
They may now.
They may now. What have you learned?
A few things. I think I've learned how valuable our culture is. I've found how resilient and adaptable our people are around the world. I've learned how much people miss travel, and I've learned how responsive we need to be to these sorts of crises. We had to not only stabilize the company's balance sheet in a matter of weeks, but roll out all new operating and cleanliness protocols in 133 countries around the world in a matter of weeks.
Tony, how difficult is it to hire enough personnel to meet the incredible demand of people who do want to get back on the road?
It varies by market, Lisa. In the markets here in the U.S. where we've seen demand spike most rapidly, California, Texas, Florida, it is challenging. And we're competing for labor not only with other hospitality and travel companies, but with those industries that have thrived, some of the online retailers and the like. We really have to be much more proactive and deliberate about reminding folks about the appeal and the opportunities that exist in travel and tourism.
Meanwhile, as we're dealing with a number of supply chain kinks and certainly labor market frictions, we're also dealing with a different international backdrop. And we had President Biden come out and warn companies about doing business in Hong Kong. How are you dealing with these types of saber-rattling warnings and possibly even more than saber-rattling, particularly with respect to China, where I know that you guys were planning to expand?
Well, we continue to expand in China. It's our second biggest market globally. We've got about 400 hotels open, another 400 in the pipeline. I think we're helped a bit. Virtually the entirety of our footprint and pipeline are owned by Chinese owners. And so we are viewed a bit more as a Chinese company versus an American company in terms of the ownership of the assets there. But again, we've got to navigate these complexities in 133 countries around the world. And it's really, I think, starts with being good corporate citizens.
Best thing you ever did was restore the old King Cole mural at the St. Regis Hotel in New York. You don't have to restore it in Hong Kong. You have a St. Regis in Hong Kong that is an absolute palace. The reality is you've got to get fat cat bankers into that St. Regis in Hong Kong. How are you going to do that given the politics of Beijing?
Well, it will certainly be a challenge. What's interesting is, at least through the pandemic, given the condition of borders in China, China is relying almost entirely on domestic demand. But when we look at corporate business travel in China in March,
what do you see right now?
We were 6% ahead of where we were in March of 19. So the volume is there, the pricing power is there, but the mix is different because it's largely domestic demand.
Tony, what about globally? Are you starting to see global travel wax or wane given the increase in Delta variant around the world?
It varies by market. One of the nice things about our business is we track and analyze the data in real time. When the EU came out with a fairly opaque statement about borders opening to international travel, we saw booking volume jump 40% in 2 weeks. When Greece came out with more specific details on what was going to be required to enter the country, we immediately exceeded demand booking volumes from 2019. Then you shift to other parts of the world, countries like India that are still struggling mightily with the pandemic. We see really muted demand patterns.
Honestly, I just actually traveled internationally, and it was amazing to see how everyone felt like they were getting in just under the wire, and they were all checking the news to see what additional restrictions might be in place on the way back. Things were different, including the number of times a housekeeper would come into your hotel room to change the towels, the concern about being in the same room at the same time, buffets that would not be out there for you to take the way that they previously were. How much of this is going to be the new normal going forward?
I think there will be changes we've made that will endure through beyond the pandemic. Some of the contactless technology we've put in place, the ability to check in, check out on the app, chat with the hotel staff through your device. We've got mobile key in more than 4,000 hotels around the world. I think a lot of that will continue. Things like housekeeping, how we deliver food and beverage service will evolve on a market-by-market basis. If you were in China today, the buffets, which are so popular, they're back.
I look at Goldman Sachs arguing about raising pay of junior bankers. Do you have to raise the pay of your line employees because of employers like Amazon competing at a lower wage and an all-in benefit package?
In some markets, absolutely.
Amazon and Jesse and Bezos, they're affecting your base wage.
I think they're affecting
to me, this
the
is
entirety
a story
of
for
the
this
travel
flow.
and tourism.
How are they doing that? What is Amazon doing in a juggernaut to affect your employee pay structure?
I think their entry-level wage rates are putting pressure on wage rates in certain markets. And I think one of the things we're wrestling with a bit, the employment market at large has often viewed travel and tourism as a bit of a safe harbor industry.
Right.
And I think some of that confidence has been rattled a bit. When you look at global occupancies dropping down into the low teens at the outset of the pandemic, all of the travel and tourism companies had to make heart-wrenching decisions around furloughs and job eliminations. And I think we've got to do a lot of work to restore confidence that this is an industry that you can build a long-term career.
Get to work. I need a $25 lobster roll. And
all right.
Coast to coast. Tony Capuano with us, their Chief Executive Officer, arguably the CEO of the year on the death of Arne Sorensen as well. Lisa, what an extraordinary day. The news flow absolutely different than what I would have thought at 9 p.m. last night.
I want to just emphasize, though, something that Tony Capuano said, which I thought was fascinating, that people don't have faith in the same careers that they did in the past, and that needs to be restored. And this really speaks to the labor market frictions that Jay Powell's going to address at noon, the idea that perhaps the participation rate isn't where it is because people aren't sure about their careers going forward. It is a new world post-pandemic than pre-pandemic time.
Yeah, no question about that. We'll drive forward this conversation, particularly on proposals of various and sundry infrastructure in Washington. We are thrilled to bring you at 12 noon Austin Goolsbee of Chicago, the Booth School. Professor Goolsbee, of course, former Council of Economic Advisors chairman. Please stay with us through the morning on radio and television. This is Bloomberg.
Okay, guys, how do you like this trade? Okay, we're going to play stop on profit even further in our advantage, and it will be 110,290. Okay? Okay, guys, we're already £2,000 in profit. Well done, all of you who decided to copy this trade. You're in, and not only in, you're in profit. Okay? If you want to get the strategy, if you want to find out what is going on, how come we can make profit, we don't lose money, you need to get a strategy. Nothing free in this world, so you can copy trade for free, you can follow our trades every day from 8 to 10 for free, but the strategy, you need to pay for the strategy. So the strategy available on company.co.uk. We give you support, we will teach you how to trade, but we're not people who trying to sell you something, we're day traders. So we make money on by trading our own money and our clients' money. So if you want to trade like we do, you can get the strategy, practice for a couple of weeks, and then you can move on and you can trade on your own by using, you can use different stocks or indices or pairs, Forex pairs. Okay, I'll speak to you later, guys. We're £2,000 in profit already, and we're still in this game. We're still in because we didn't sell yet. Stay safe.
From New York, we begin with the big issue, turning to Chair Powell for answers.
Chairman Powell. Chairman Powell has a very difficult job.
The risk of a policy mistake is elevated right now.
Inflation is front and center in everyone's mind.
And that speaks to today's testimony.
We hear from Chair Powell.
That will be a key. He's got to walk the fine line between retaining his credibility. Credibility is a tough one. And also helping to keep inflation expectations anchored.
He's going to sound sanguine on the inflationary pressures.
The important thing is really how he navigates the view on tapering.
Board members who have been a bit more dovish, and that includes Jay Powell in the testimony.
He will remain calm.
Nothing dramatic is going to happen today. It can't.
Nothing dramatic is going to happen today. It can't. Joining me now is Kathy Jones of Charles Schwab and Vishy Tripatur of Morgan Stanley. Kathy, let's begin with you. Chairman Powell, hours away. What are you looking for?
Yeah, I don't look for any fireworks from Chair Powell. I think he'll be pushed on the inflation question, and I think he'll push back and say, try to pivot to employment and focus on the fact that the recovery is not complete when you look at the employment outlook. But I do think he'll have a tough time navigating the topic because everyone's talking about inflation, and we just have gotten some very high prints right now.
Hot CPI, hot PPI. Vishy, your take.
I agree with Kathy. I think he will be. This is a topic that is at the front and center. So he will be pushed by both sides of the aisle, and I think the conversation will revolve around what parts of the inflation are transitory and what parts are not, and what does it do to the timing of everything, timing of tapering, pace of tapering, the timing of liftoff and everything associated with that.
Emphasis will matter here, and I've had a lot of people say to me that maybe this is an audition for a second term at the central bank. Kathy, would that shape your view on what you could expect from Chairman Powell a little bit later?
Not really. Obviously, I think he probably enjoys very much being the chair of the Fed, but I don't think that he's framing his comments with that in mind, simply because it doesn't look like from the written testimony that he's veering at all from where he's been for quite some time. So, I think that this Fed is very different from previous Feds that we've seen. And this is the important thing that's driving market and market expectations. This is a Fed that really wants to see full employment and is emphasizing that over inflation. And I think the markets are still struggling with that because this is a big flip from where we've been for the past 40 years. And so I don't think that that's a shift for Powell, but I think it's something the market's really going to and Congress is really going to have to dig deep on and try to figure out if that's what they want.
Well, we've already had a little look at his testimony, and here's a quote from it. Quote, while reaching the standard of substantial further progress is still a ways off, participants expect that progress will continue. Mike McKee, our international economics and policy correspondent, with us now. Morning, Mike.
Good morning, John. Well, progress continuing means that inflation at some point has to come down, since the Fed continues to say it's transitory. But the PPI numbers we got today following yesterday's CPI aren't going to make his job any easier on Capitol Hill. On a month-over-month basis, we get a 1% rise, and that translates into a 7.3% increase on a year-over-year basis in producer prices. That's a record for this series, which goes back to about the turn of the century, about when they changed the methodology. And so for Powell, it's going to be a day of explaining why inflation is going to go away and how these congressmen's constituents are not necessarily going to suffer. In his remarks, Powell said inflation has increased notably, acknowledging the obvious, and will likely remain elevated in coming months before moderating. And what's important, he adds, is that measures of longer-term inflation expectations have moved up from their pandemic lows and are in a range broadly consistent with the FOMC's longer-run inflation goal. So they're not seeing anything to worry about in the data on inflation expectations, and the data on actual inflation is going to change. That's a tough message for the chairman to deliver these days, but they seem to be determined to stick to it.
Mike, do you think we need to get away from this word transitory? Do you think we need to change the conversation, the communication over at the Fed a little bit? Do you think this is confusing things more than anything?
It's not speaking in the language that ordinary people talk about, so you can expect maybe some questions about temporary or something like that. But the Fed has settled on this language. I think they're working with the surveillance producers for your drinking game. They're going to probably stick to this idea that it is transitory. The idea being that this is just something that comes and goes. We don't have to worry about it longer term.
Mike, have we disrupted your vacation to hear from you for Chairman Powell? Where are you?
I'm in Victor, Idaho at the Rocky Mountain Economic Summit, and no, it's not a vacation, unlike certain people who take as many vacations as they can.
I assume you're talking about Tom Keene and not me. Mike, it's good to see you. I wish I was with you. Michael McKee, our economics correspondent. Kathy Jones, I want to turn back to you on this word transitory, and I just wonder how unhelpful it actually is, because when people argue about it, they're often arguing over different things. There are some people that say, well, the price of X has changed and it's not going to reverse. There are other people that will say, well, it's not about that, it's about rate of change and the factors that have led to this higher rate of change, and they will fade over a certain period of time. Then we can have an argument over what period of time. What are we actually arguing about, Kathy, in your mind, and what should we be debating?
Oh boy, when we get into the inflation conversation, it is really challenging, whether it's with, say, our retail clients or institutional investors. It's all over the map. I think we are talking about rate of change, but we also have to talk about what effect Fed policy can have on the inflation that we're experiencing. In other words, if the Fed raises rates right now, does that make the price of used cars come down or airfares come down? I think that it is worth pointing out, as Powell did, that the five-year forward right now is sitting about 212 or so. That's right in the sweet spot of what the Fed would like to see, inflation end up with over the long run. So although there's a lot of turmoil in the numbers right now, Fed policy is pretty blunt in terms of what it can do. Do you want to slow the economy down before employment's come all the way back to get this spurt in inflation down and end up perhaps where we were after the financial crisis with subpar growth?
Yeah, I just think there's a better way of communicating this, and you've done a decent job of framing it for us, Kathy. Vishy, the way to do it is to say these are our labour market goals, and we don't think this price surge will overwhelm the recovery and stop us from being able to achieve them by keeping monetary policy accommodative. Isn't that the conversation that would be a little bit more beneficial to this audience and others and people on Main Street to really understand what's going on here?
I think what is helpful is to talk about more specific things. What components of inflation are going up, and what components are potentially going down, could be going down. So the way I would look at it is that we had a pandemic, and there were certain pandemic winners. And I'd say we should acknowledge that the pandemic winners we thought might begin to fade by now. Used car prices would be an example, have not faded. So clearly those remain pretty strong. And then there are other things that are happening. I will put the shelter inflation in this context. If we talk about that component, we think that there is shelter inflation has a lot more room to run higher from this point onwards. So I think what probably will be helpful is actually not talk in terms of the specific components of inflation, things that are going to fade and things that are not going to fade.
It's an increasingly complex conversation to have. The additional layer of complexity of issues to try and work out what this means for the market, because yields have been pinned down south of 150 for a while now. We had another break of 140 this morning off the back of a PPI print that came in hot. Off the back of some accommodative language from the Federal Reserve Chair. Yields are down 4 or 5 basis points on 10s, on 30s. We're back to 137 on 10s and a little north of 2% on 30s, respectively. Vishy, what is that? What is that price action? What is that reaction to those inputs?
I think, there is a lot that's going on. So I wouldn't pin down a specific narrative just purely on the 10-year point. I think what's more instructive is look at the shape of the curve and also to realize that a lot of these moves have to do with positioning shifts. We went to a period where, just look back at March, from March to now. So we were into a period where the narrative was that we look for a very strong recovery, a million jobs not from payroll number a month, and that was the narrative for some time, and that meant that people interpreted that to mean that rates will go significantly higher, and that was really not the driver at the time. In our view, my colleagues Guneet Dhingra and Matt Hornback have highlighted it. It's really changes in the positioning from the Asian buyer base that actually created that move upwards. And we think at the same time, what we now see is the reverse of that. What we are now seeing is really an unwind of some of those positions, and that is causing a lot of these moves. So I think the bottom line is at this level of the 10-year Treasury we don't think is a sustainable level. We expect we would be recommending being outright short on the 10-year Treasury, and for 10-year Treasury to move higher back into the 150, 160 range and heading towards 180 by end of the year.
That is what the bank bulls want to hear. We're going to be talking about that in just a moment. Vishy, stay close. Vishy Tapatur of Morgan Stanley, Kathy Jones at Charles Schwab is going to be joining us to give her view on the yield curve and the bond market too, and what it means for these bank equities. We'll do all of that in just a moment. Let's get to the market desk and get your movers. Here's Abby.
Good morning, John. And we do have green on the screen for futures, helping out some nice earnings stories. Starting out with the airlines, we have the airlines overall popping higher. American Airlines not even announcing today, pre-announcing in a way. Yesterday, the CEO Doug Parker told employees that the company that they put up revenue and expenses for the quarter came in better than expected, achieved by bringing operations back to full capacity. Delta did, in fact, report this morning up less than American Airlines, which essentially pre-announced. They put up a big beat, and they also said that they see solidly profitable second half. United Airlines going along for the ride. Turning to the banks, mixed action here, as you know. Bank of America down after they missed revenue estimates. Tepid loan income, consumers avoiding debt flush with cash from the government, and also not doing as much as they might have done over the last year. Citigroup, on the other hand, they saw or see better loan growth for the second half, those shares being rewarded. Wells Fargo up 0.6%. They put up a big beat. Their loan activity stalled. However, they're saying wealth management good. And obviously, John, yields in today not helping out the group overall, but you can see Citigroup and Wells Fargo really bucking that trend. Bank of America,
Abby,
not so much.
Thank you. Abigail Doolittle on these banks. Much more on the bank results as we await Morgan Stanley tomorrow. We'll catch up with Gerard Cassidy of RBC Capital Markets from New York City this morning. Good morning. 18 minutes away from the opening bell stateside. This Wednesday, your equity market shaping up as follows in the United States of America, making another push back towards all-time highs on the S&P 500. Equity futures up 16. We advance 0.4%. This is Bloomberg.
now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there has been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada is going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
I think what we've seen during this period of time is that communicating via video is not a fad, that we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Eventually, we expect higher interest rates, higher loan growth, higher traditional banking revenues, higher revenues from Main Street. And when that comes, that's the next part of the story. So do not leave the U.S. bank stock show yet. It's just intermission.
Only Mike Mayo would be excited over the U.S. bank stock show if it was a movie. Just Mike Mayo, still bullish. Elsewhere, shares of Wells Fargo and Citi gaining ground on surprise beats, but Bank of America lagging with some tepid loan growth weighing on the stock. Shanali Bassett wrapping all of this up for us in the last 24 hours. Morning, Shanali.
Morning, John. It's funny to see Mike being so bullish on the bank stocks when he's so tough on the bankers themselves. Over at Citigroup, right, you see a beat in ROE, returns on equity, but investors are being so discerning line by line, business by business. What's to love over at Citigroup? That equity trading revenue had the biggest jump on Wall Street. Right now, we are talking to CFO Mark Mason with, in a call with the media. He is talking about the opportunity to gain share in prime brokerage. Certainly after that Archegos debacle had really shifted the winds here across the whole industry. Beyond that, we are still watching loan growth. Mason is giving us a reason to hang on, kind of like what Mike Mayo was saying. But over at Bank of America, the proof needs to still be in the pudding, and you see that in the investor reaction in the stock.
You do. Shanali's going to be back in about 14 minutes to give us a deeper dive on some of these names. Shanali, thank you. Back with us is RBC's Gerard Cassidy. Gerard, I know you're super crushed busy this morning. I'll try and keep it brief for you, but thank you for your time, sir. Just run me through your thoughts on the past 24 hours.
Certainly, John. I think what we saw in the last 24 hours is that the investment banking results across the board were stronger than expected, led by advisory. Goldman Sachs so far stands out as having the best capital markets numbers in that investment banking area. Trading, on the other hand, was mixed. Fixed income trading was down. Equity trading was up for most of the banks. When it comes to traditional commercial banking businesses, credit, very strong. The loan loss reserve releases are very strong, but it's all about loan growth. And here the trends are mixed. What's interesting is that we've got to be cognizant of average balances versus period end balances. And though today Bank of America's average loans were down, they have a very important slide in their deck showing period end balances are up in loans, suggesting loan growth is coming for them and others in the second half of the year.
Let's talk about that more broadly. The challenge to that, Gerard, and I always say, you're far smarter than me on these banks. You're the man I call. So I'm going to make the question for you and you can answer it. When I see things, and I try and make them pretty simple, when I see deposits still surging, it's hard for me to understand where the loan growth is going to come from anytime soon. How can you make that argument this morning for us?
No, it's a good question, John. And I would say it's twofold. First, on the consumer side, think about what's going to happen in the fall. All student loan deferments end. The rental deferment program for apartments that you're aware of, that's ending as we speak. You also will have the unemployment benefits go away, the enhanced ones. So I think the consumer will go back to a pre-pandemic position, and that's a revolving position. And then on the corporate side, this is the weakest areas by far. And part of it has to do with the excess liquidity. We agree with that. But the supply chain problems are very severe. As you know, you look at the car dealerships, their lots are half full. So lenders into those car dealers are not seeing the drawdowns. As the supply chain problems work their ways out over the next 6 months, 12 months, you're going to see commercial loan growth come back to rebuild inventories in our view.
What do you think is more important, Gerard, the trends that you've just described, and final question, or what happens in this bond market on my screen?
Yeah, no, John, you get to the heart of the matter with that. The 10-year government bond yield is important, as is the rise in potentially short-term rates. So if we're sitting here, John, talking about third quarter results in October, and the 10-year is at 1.1%, the bank stocks are not going to be working. On the other hand, if the 10-year is at 1.6, 1.7, the stocks are going to be a place to be.
Gerard, you're a good man for making some time for us this morning. I know how busy you are on bank earnings week. Gerard Cassidy there of RBC. Back with us is Kathy Jones of Charles Schwab, Morgan Stanley's Vishy Tripator. Kathy, we heard from Vishy about where he thinks this bond yield curve is going to go. What's your take?
Yeah, I agree with Vishy. I'm usually in the lower for longer camp. I've spent the better part of my career there, but I do think yields are too low. They're inconsistent with where the real economy is going. We're looking at, pretty healthy growth for the next couple of years, probably at least this year, next year, maybe into 2023. And real yields at this level seem inconsistent with that. So we're also looking for a pretty good pop in employment in the fall around education, et cetera. And so I think that there's more room for yields to move.
We await that Chairman Powell testimony. Kathy Jones, Vishy Tripator, thank you very much for being with us. Coming up on the programme, the morning calls, and later, inflation data putting the spotlight on companies after pricing power.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lines in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
4 minutes, about 30 seconds away from the opening bell in New York City this morning. Good morning. Equity futures positive 0.4% on the S&P. On a Russell, we recover 0.6 calls. First up, Wedbush downgrading Peloton to neutral. The analysts seeing signs of substantial correction in engagement in the aftermath of the pandemic. Elsewhere, Raymond James upgrading Ulta Beauty to outperform $395 price target. The analyst expecting the company to benefit as consumers get out of the house and prepare for more in-person socializing. That stock up by a little more than 1%. And finally, Deutsche Bank cutting its price target on ConAgra to neutral and maintaining its hold rating. The analyst citing the company's mixed earnings results and a weaker outlook. Coming up on the programme, futures pointing to a higher open as bank earnings. Tenths of 1% to $75.10. That's the cross-asset price action of the market desk with your movers. Here's Abby.
John, it's that possibly puzzling action in yields that you were just talking about, that 10-year yield down 4 basis points ahead of Fed Chair Jay Powell's testimony, expecting to stay on message. Generations in 2021, that information is coming from the supply chain that Apple is asking its suppliers to create 90 million iPhones.
Remember, these banks have de-risked a lot, John. The other interesting dynamic we're seeing is that growth in wealthier consumer loans versus the rest of the economy. As we know, we have some big headwinds still ahead in the economy, those student loan repayments, mortgage forbearance is rolling off. So again, these bankers are now, Bank of America and Citigroup, pointing to upticks, but that doesn't erase what we're seeing now, for example, in home loans that are seeing a little bit of weakness. Interestingly, too, we're seeing cost control at a lot of these banks, but at Bank of America and Wells Fargo, part of that means in lower headcount, right? So what are they going to do in terms of jobs through the end of the year as some of these items are under pressure? We are seeing them invest in certain businesses, and right now we know, I mean, the clear winner in this earnings season are the investment bankers. The fact that Citigroup just posted a 37% jump in equities trading, they and Bank of America growing in equities and prime brokerage, while we know some of the Europeans are stepping back, is an area for more potential investment.
Just saw that banner there, Shanali. RTO, is that return to office? Is that what we're using now? RTO, return to office.